Evening. On behalf of SIRC of ICAI, I welcome all the members to today's program on capital account transaction and compliances under FEMA. Today we have our distinguished speaker, Mr. Mohammed, Kader, Abdullah, sir. I request you to occupy this chair, sir. Before we begin the session, I like the members to rise up for the ICAI motto song.
सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शितः सर्वे तदूनाचरितश्च एतद्वैता एतद्वैता एतद्वैता
Thank you. Before we begin our session, I would like to give a short summary of Mohammed, Kader, Abdullah. With over 30 years of experience in banking industry, Mr. Kader is a certified associate of Indian Institute of Bankers and has developed deep expertise in FEMA advisory and compliances, forex regulations, capital account transactions, corporate banking, financial markets, and trade and cash solutions. As a senior associate director at Standard Chartered Bank India, he has been a key contributor for the past 18 years, specializing in foreign exchange regulatory compliance and financial solutions. In addition to banking experience, Mr. Kader has been a corporate trainer and speaker for over 10 years, conducting numerous internal and external sessions to enhance industry knowledge and regulatory understanding. As a recognized FEMA industry expert, Mr. Kader has provided invaluable insights on foreign exchange regulations and compliance, working closely with top consultancy firms such as EY, BDO, Kaitan & Co., PwC, etc. Kader is a sought-after Forex and FEMA expert, providing strategic advisory services to many companies. His insights help businesses navigate complex financial regulations, ensuring compliance and optimizing financial strategies. On behalf of SIRC of ICAI, sir, I thank you for accepting our invite and taking your time to be with us today. As a token of appreciation, I request CA Ranganathan sir to give memento to Mohammed, Kader, Abdullah.
Okay, so first of all, thank you for SIRC for giving me an opportunity to take up the session to the well-known industry at CA Industries, and also I thanks for all to registering the session to enhance your knowledge on capital account transaction. Being a banker, you might be having lot of gray areas under FEMA, which requires AD Bank's input, since the regulation has been known to everyone, but the practical aspect which can be given only by the banks by discussing with Reserve Bank of India on the solution to the problem. So today since it is a 3-hour session, I just wanted to plan it in a 3 or 4 divider. First is I wanted to take capital account transaction of FDA, ODA, ECB and LOBO PO for around 1.5 hours. Then the next half an hour I am going to take what is the recent important FEMA changes, and there are certain case studies which we have handled at our end. Then at the final 1 hour, I just give it for Q&A session, because I hope most of you having a number of clarity which require to be answered from AD perspective. So with that introduction, let me start the session. So capital account transaction, I am not going to take the current account transaction. First of all, the transaction will be divided into current account and capital account transaction. This FEMA would be applicable wherever a transaction is happening between person resident in India and a person resident outside India. So capital account transaction definition is if any transaction which is altering assets and liability, including contingent liability with a person resident outside India, then that will be called a capital account transaction. So all other transactions will be classified into current account transaction. The thumb rule with respect to how we need to identify, how we need to take it up with respect to current and capital account transaction. For current account transaction, all transactions are permitted unless specifically prohibited by Reserve Bank of India. So this is the common rule which is given that current account transaction is all transaction is permitted unless specifically prohibited by Government of India or Reserve Bank of India. So if you see, there is a current account transaction rules which give Schedule 1, Schedule 2 and Schedule 3. Schedule 1 talks about transaction which is completely prohibited. Schedule 2 where the transaction which requires prior Government of India approval. Schedule 3 where which required prior RBI approval. So those are the, except those three, all transactions are allowed as per the current account transaction. Coming back to capital account transaction, the thumb rule is all transaction is prohibited unless specifically permitted by Reserve Bank of India. So that is complete reverse of current account transaction. So there is a set of rules have been given by Reserve Bank of India for each of the capital account product. So we have to be guided by that particular regulation. If nothing is mentioned on that regulation, we cannot anticipate or we cannot interpret in a different way and cannot continue with the transaction. That requires prior Reserve Bank of India approval for those kind of transaction. So coming back to capital account transaction, so the main classification of capital account transaction is foreign direct investment, overseas direct investment, external commercial borrowing. These are the three important product of capital account transaction. So one will have to look into that, and RBI has given separate master direction, separate rules and separate FAQ for these particular products. For FDI there is a separate rules and regulation. For ODI there is a separate rules and regulation and direction, and there is a separate rules for ECB. So we'll have to go by that. So whatever is mentioned over there, only we'll have to go by that. If nothing is mentioned, interpretation in a different way, that can lead into non-compliance of the regulation. So we'll start with overseas direct investment. So overseas direct investment, which means an Indian entity who want to invest outside India. So that is a permissible capital account transaction. So overseas direct investment and overseas portfolio investment, there is a two kind of investment which resident entity or individual can undertake with respect to acquiring foreign securities. So acquisition of any unlisted capital of foreign entity. So what is overseas direct investment? We'll have to see acquisition of an unlisted foreign company shares, then subscription to MOA of the foreign entity. Investment of 10% or more paid up equity capital of the listed equity capital. So up to 10% will qualify under OPA, above 10% it will be qualifies under ODI, overseas direct investment. Investment with control where investment is less than 10% of the paid up equity capital of the listed foreign entity. So if you, I'll come through when OPA comes. So even if the listed entity less than 10% which qualifies as an OPA, but somebody is having control on that particular company, then also that will be qualified as under ODA. Control means right to appoint majority of the directors, right to control management, manner of acquiring control, normally 10% voting. So as a normal practice, if somebody is having more than 10% stake in the foreign entity, it assumes that they are having control in that foreign entity. So this control aspect will be more relevant when the FEMA requirement compliance is coming. Indian entity. So I said Indian entity and resident individual. Indian entity which includes company incorporated under the Companies Act Regulation 2013, a body created under the Act of Parliament, a partnership firm registered under the Indian Partnership Act, and a limited liability partnership which is registered under LLP Act 2008, and a resident individual. So these all will qualify as an Indian entity. So they are permitted to invest outside India. So there are set of rules and regulations given for resident individual and rules and regulations given for Indian entity. Foreign entity, earlier it was known under joint venture and only one subsidy, now has become foreign entity. So any entity which is registered, formed, incorporated outside India, so that will qualify as an foreign entity. Even if the entity is incorporated in IFSC, GIFT City in Gujarat, so that entity also will be qualified as a foreign entity. That's a net worth. The net worth is one of the basic concepts, is capital plus reserve and surplus plus share premium as per the latest audited balance sheet. Okay, this I'll come to that. Equity capital. So equity capital, what are the things which is qualifies as an equity capital is equity shares, perpetual capital, instrument that are irredeemable, contribution to non-debt capital of the foreign entity, which is in the nature of fully and compulsorily convertible instrument. That is compulsorily convertible preference shares and compulsorily convertible debentures. So those also will be qualified as an equity capital. So an Indian entity, when they want to invest in a compulsory convertible preference shares of the foreign entity, still that will come in the ambit of ODA regulation. Not only equity capital, they are allowed to invest in compulsorily convertible preference share or compulsorily convertible debentures. Any instrument which is other than compulsorily convertible, like optionally convertible preference share or normal preference share, normal debentures, those instrument will be qualified as a debt instrument and that cannot be treated as equity capital. Safe instrument are not permitted instrument under OA rules, because many of the queries which comes to us that whether safe instrument issued by US entity can be considered under ODA. So that is not the instrument which is qualifies for investment to be made under ODA regulation. Overseas portfolio investment. So earlier we have seen ODA, now it's OPA. So investment other than ODA in a foreign entity in general will be qualified as an OPA, overseas portfolio investment. Normally overseas portfolio investment will be made on a listed entity share. So suppose if an individual want to invest in a listed company share outside India, they want to buy Apple share, so they can go and approach the AD banker and make the remittance under OPA. So whatever remittance made by individual will qualify under liberalized remittance scheme, but still within the available limit of 2,50,000, they are allowed to invest in a foreign listed company shares as well under OPA. Investment in units of any of the investment fund, VCF, AFF overseas, which is regulated by host country regulation. So RBI is also wanted to ensure that whoever is invested from the India, they want to ensure that their money would be also safe. So what the condition which has been put up by RBI is, if they are wanted to invest in any mutual fund or anything in outside India, that fund has to be registered with the host country regulator, so that the money should be on the safer side. So shares acquired by right resident individual through sweat equity, ESOP, minimum qualification shares up to 10% of paid capital shall also qualify under ODA. So employees, not only they can make the remittance, even by way of getting a shares by way of employee stock option scheme or any other scheme, no. So that is also can be done, up to 10% will be qualified as an OPA. This particular 10%, irrespective of whether the company is listed or unlisted, if an Indian employee is getting a shares of a foreign company by way of ESOP, whether it is listed or unlisted, up to 10% will be qualified as an OPA. If he is separately investing in an unlisted company, then that will qualify as an ODA. OPA, Indian entity make OPA on the last audited balance sheet. So Indian entity. So OPA, who can make OPA? Individual we have seen already, now entity. So who can make ODA under OPA by the Indian entity? Only listed company eligible to make investment in a listed company outside India. So unlisted company in general cannot be allowed to invest outside India in a listed company. and how much they can invest by a listed company in India is up to 50% of the net worth. Net worth we have already seen what is covered net worth, and the last audited balance sheet which is giving should not be more than 18 months from the investment. Today, assuming today if somebody is wanted to invest, the latest audited balance sheet should be on or after 18 months prior to this date. That means from 1st October. 18th October, 31st October. So 31st October 2023. So audited balance sheet should be on or after that. If somebody is giving the application having audited balance sheet of 31st March 2023, then it is exceeding 18 months. They will have to do the auditing of 2024. Then only they are allowed to make the remittance under ODI or under OPA, whatever mode. So unlisted entity can make OPA only certain criteria that I'll come back to you later. And OPA by person resident India and the listed equity capital of a listed entity even after it leads into OPA. So there is a concept which we have given that if it is more than 10%, okay, that will be qualified as an ODA. If a listed entity or individual who is investing more than 10% in a listed entity, that will qualify as an ODA. Assuming if their percentage is come down to less than 10%, but still their initial investment which was made as an ODA, that will continue to be ODA only. It will not change. So relaxation with respect to earlier FEMA 120. So if you see earlier regulations, this new OA regulation which was implemented in August 2022, 22nd August 2022. So prior to 2022, there was FEMA 120, which is investment to JV and WOS regulation was there. There was complete revamp of the regulation at the need of the hour. So they have given lot of liberalization with respect to earlier FEMA regulation. So we'll go through one after one. First is deferred payment of consideration. Earlier under FEMA 120, deferred payment which was not allowed to be given. So payment has to be made upfront and has to be obtained later. So now they have given deferred payment consideration. We will come back later on that. Then second is investment disinvestment by Indian entity. If any Indian entity wanted to make investment, if they are into the investing agency or any regulatory body, they are not allowed to invest under automatic route as per the earlier regulation. So now that liberalization which has come with a certain liberalization, we are allowed to take under automatic route. Third is issuance of corporate guarantee on behalf of second or subsequent level of subsidiary. Under the earlier regulation, issuance of corporate guarantee by the Indian entity beyond the second level which requires Reserve Bank of India approval. So now they are allowed to give a number of subsidiary as long as they are holding control. Write-off on account of disinvestment. Write-off under earlier regulations allowed under automatic route with certain conditions. If the condition was not met with, it has to go under approval route. Now that completely liberalization which was given to the AD bank, that AD bank can take a call on write-off of disinvestment under the automatic route. Introduction of late submission fees for reporting delays. So under FEMA 120, if any delay or any non-compliance will leads to compounding only. There was no option of late submission fees to be given. Now with the introduction of late submission fees, so RBI has given the liberalization to Indian entity. Whoever is not complied with the FEMA regulation, they can go and make the payment and to regularize so that there won't be further non-compliances with respect to those transactions. So deferred payment consideration. What is deferred payment consideration? Deferred payment consideration, normally shares should be acquired first and payment would be made later. So this was not allowed earlier. Now a person resident in India is acquiring equitable capital of a foreign company. So they are allowed to make deferred payment. Today I am receiving my shares, but I can make the payment after down the line 3 months, 6 months, 9 months, 12 months. That period can be agreed between the investor and the company. The period, but the period should be decided upfront. There should be a deferred agreement, and the agreement should be between the investor and the company, and they will have to agree to when the payment should be made and how long that will be made, etc. should be given. and full consideration whatever paid, the payment will be made in installment, but whatever the total consideration should be paid should be in compliance with the pricing guidelines. And another important case is in case of remittance towards acquisition of equity capital. So what regulation says, there is a form called Form FC. So that has to be filed with Reserve Bank, with an AD bank whenever a client wanted to invest outside India. So when this Form FC to be filed, the Form FC to be filed before acquiring foreign securities or before making remittance, whichever is earlier. So that means when a company, assuming in certain countries where shares would be automatically allotted at the time of incorporation of the company itself, assuming in case of Singapore, wherein the shares should be automatically allotted at the time of incorporation of the company. In Accra report, you can see that shares allotted, amount unpaid, so and so rupees, so and so dollar. So what the regulation says that Form FC, there is a form which has to be submitted to Reserve Bank of India through authorized dealer before acquiring or before making, whichever is earlier. So in this case, when client is normally when they are coming to AD bank is when they want to make the remittance, that point of time only they are coming to AD bank, that showing that I wanted to make a remittance for $200 towards the initial subscription of my entity which incorporated 1 month back. Okay. So the regulation is very clearly said that they should have come prior to incorporation of the company, 1 or 2 days prior to incorporation of the company, and submit the Form FC and comply to the FEMA regulation and get the UIN. UIN is unique identification number. So that point of time, what will happen? That is assuming there is a 200 which is due to be made payment. So they will have to give the documents which is required to be given to the AD bank. They have to give the document, and AD bank will report those 200 into the OID portal as a non-fund financial commitment. Then they will allot the UIN, because as of now that is considered as a future deferred payment. So later, once there comes up payment again after couple of times, whatever time period which is given after 2 months, 3 months down the line, again he need to give Form FC and quoting the reference number of when he has submitted the Form FC and make the remittance. That point of time, AD bank will not report as a fresh transaction, since this transaction was already reported under non-fund based. They will have to convert those non-fund based into fund based and report the transaction in the OID portal. So most of the cases where individual or company who is coming up to bank only post incorporation of the company, then they are bound to have non-compliance with respect to FEMA regulation. NOC from lender bank regulatory body. This is one of the relaxation which earlier if any entity which is under investigation, they will have to get under approval route. Now there was a relaxation. Account appearing as an NPA. If any account appearing as an NPA, or they are classified as a willful defaulter, or investigation by a financial sector regulator or investigate agency, then NOC needs to be obtained from these financial before making any financial commitment. Assuming a client of Standard Chartered Bank who is already holding an account with ICICI Bank, the ICICI Bank which is classified as an NPA. So this client is coming to Standard Chartered Bank for making an ODA remittance. Since one of his account is classified as an NPA in ICICI Bank, they need to get NOC from ICICI Bank to make the remittance of this ODA. So with that, we can able to allow the remittance. Earlier, once it is become NPO, they are not allowed to make any financial commitment or any ODA remittances. Now with the obtention of NOC from that particular bank, so we are allowed to make remittance. Similarly, in case of this investigation agency or any of the agency enforcement director, if somebody has been catch hold of enforcement director, then they will have to get NOC from that particular investigation agency before making any financial commitment. The timelines is also given in case they have given application to the AD banker, assuming the earlier case, they given application to ICICI Bank for obtaining NOC because they want to make the payment through Standard Chartered Bank. But the bank has not taken action on 60 days. They are not taken action on 60 days. Then it is assumed that that has been completed, I mean NOC has been given. So they can wait till only 60 days. Beyond 60 days, if there is no approval, if there is no confirmation coming from that particular bank, it is assumed that NOC has been obtained. And accordingly, the payment can happen from other bank. Ah.
Investigation agencies, right? So let's say there's an enforcement directorate inquiry, then it's just an inquiry, it doesn't mean anything.
Yeah.
No objection is not required, right?
No, anything.
But they will never give a no objection.
No, they will give. That's what the second thing is. In 60 days, they can give. What they can do, they can write a letter to them asking for NOC and with a CC to AD banker. Okay. Then they will wait for 60 days. Then they'll say they have not received any response from within 60 days. That assumes that NOC has been obtained.
But practically will they give the NOC? Because they can just keep saying, no, it's an inquiry, I won't give you an NOC.
No, this is nothing but, see, they RBI wanted to just information to be made to that particular investigation agency that he is going to do a transaction with a person outside India. Okay.
The reason I'm asking is because let's say an inquiry came 5 years back, for example. So the person never gets a intimation on closure of investigation. It's always open until the person dies, it will be open.
Completely.
If the company is alive, it will be open.
Yeah.
The moment once they receive any inquiry, which means that lifelong they'll have to keep checking and getting an objection.
Yeah, see, that closure of that inquiry will be different. That will be continued till the time that has been completed, investigation, everything. But in between, he wanted to undertake one transaction, which earlier, which was not allowed by RBI. Okay, once somebody is under investigation agency, they are not allowed to make any remittance at all, unless the investigation is cleared. Okay. Now, even if that is pending under investigation, because he wanted to make the remittance as a fresh, if they give NOC, they can do the remittance. Okay, they can wait till 60 days to get the NOC. Assuming in your case, if they are not at all responding to the letter which is made by the company. Okay.
Response saying I have objection.
If they are telling the objection, then they cannot make the remittance.
This objection is not actually reasonable. Let's say it's unreasonable. Because sometimes, especially with inquiries, what generally we see is that it may not really be reasonable, right? You can just keep asking questions. They never close. The fact that they never close something means that it's not a very clear, transparent process, right? So would it mean that once a person has got a notice, it means that through their lifetime, if they want to make any ODI, they have to just go back to the agency and again.
Yeah, they have to get NOC. Earlier, no, see, that's what the relaxation which was given now. Earlier, no, there was no question of approaching them to get an NOC. They'll have to clear the pending cases which is pending with a regulator. That never clear. That's what I said. No, they once the person which is under investigation, they never invest under ODA earlier rules. Now at least there are some provisions which has given that you get an NOC. Even if you don't get the NOC, you will wait till 60 days. Then we will treat that as an no objection for the remittance.
Practically, how does the AD know that there is some investigation?
That no, we are not. No, we are only going by the declaration by the client. There is a section. There are various forms which is there. One of the section declaration made by Indian entity. In that they are confirming we are not under investigation with any of the agency, etc. So we will go by that only. If he is mentioning something that yes, we are under investigation, then AD Bank will ask them to get an NOC from them. So everything is based on declaration. AD Bank cannot know each and everything what is happening behind client thing. So all basis certain declaration only will have to go by that.
So just one more question. Let's say the person has got an inquiry notice 10 years back. Naturally, nothing has happened after that.
But still they are under investigation only. As per them, they know very well it has not been closed. Okay, maybe other people may not be known.
Because there is no closure process.
Any
No, no.
differentiation between an initial summon and the subsequent process of investigation? Because all summons does not partake the character of a regular investigation. So should the person doing this transaction also distinguish between whether it is only a summon or an investigation?
Investigation.
Only an investigation. So initial summons, it may not qualify as an
Yeah.
investigation.
Unless there is show cause.
Yeah, correct.
Sir, and one more question that, if you, for example, when you said that I have to make a ODI, for example, I have already subscribed for the shares, the non-fund based, I first approach, non-fund based, I have given the intimation. There is a deferred payment. So there are 3 payments deferred. So first payment I have done. Before the second payment, there was an investigation. Then I am declaring that there is an investigation. And I am approaching and I am getting an NOC. Example, I am getting an NOC. Second payment is made. Third
This is the practical one. As of now, that is fine. It's because you are already intimating to investigation agency that you are going to invest in this particular company. This is the amount you are going to invest. Okay. So that itself will complete everything. See, the only part of that amount only you are going to make as a subsequent tranche. So I don't think separate approval is required unless and until you make different ODA to different entity.
So in that case, again, I have to
Again you will have to go. Okay, this entity you already, see, you are already disclosed, assuming there is a Singapore entity, $300, $100 paid, second is 100, third is 100. So when you are approaching to the investigation agency, you will be mentioning that I am going to invest $300 to Singapore entity. Okay, you give no objection certificate. They given the no objection certificate. So with the 300, they got the no certificate. Now you pay 200, another 100. So that certificate itself is included for total amount. Simultaneously, you are incorporating another UK entity. Okay, so you cannot take that approval for UK entity. So you will have to approach again to them that investigate that I am going to make investment in UK entity. You please provide your NOC for approval. Subsidiary, step-down subsidiary of a foreign entity, ODA FDA structure. So earlier ODA FDA structure which is not allowed under automatic route. So ODA FDA structure nothing but investment which is being made to outside India. That entity again directly or indirectly coming back to India as an FDA. So that is called ODA FDA structure, that is round tripping structure. Okay. Round tripping structure earlier which was not allowed under automatic route, that requires specific RBI approval. But now with the relaxation of OI rules, they given certain relaxation that up to 2-layer level, it can be allowed under automatic route. If the layer is beyond 2-layer, then it is under approval route. The layer, 2-layer, the layers start from foreign entity, not from Indian entity. Assuming an Indian entity has invested in Singapore entity. Okay, this example we can see, no? Singapore, the X Limited hold 51% is in UK, and UK Limited hold 11% in Germany, and Germany holds 15% in Singapore. Okay, so in this case, fund is not coming back to India at all. Everything is going outside India. So there is no restriction. A number of layers can be made outside India. Okay, the moment when it is coming back to India, we'll have to see how many layers in between, so that in between layers should not exceed more than 2 layers. If it is more than 2 layers, then it is required Reserve Bank of India approval. In your second case, X Limited hold 51% in UK, and UK hold Germany. Second, third is Germany holds Singapore, and fourth is Singapore holds India. So you mean to say we'll have to see the layer start from foreign entity. So here if you see UK is the layer. The first level would be Germany. The second level would be Singapore, and the third level is India. Since there is more than 2 layers inside, so it is not allowed, this required RBI approval. Instead of Germany is making Singapore, if Germany is investing into India, then it is a second level. Okay, UK is the first level. Sorry, UK start from UK, Germany is the first level, and Germany directly investing into India, which is second level, that is permitted.
So this covers associates also. Associate, you mentioned subsidiary, but this transaction looks like associate.
No, it's subsidiary only. I mean, JV.
Significant holding after that.
Huh?
See, India holds significant holding. Subsidiary, why?
Correct. I'll tell you what is that. So how do you consider that is subsidiary or step-down subsidiary? If any entity which is holds more than 10%, that control aspect we have seen in the beginning. If any entity if any entity which is holds more than 10%, which is considered they are holding control, and all this regulation would be applicable. It's not 51%. Here if we see 11%, 15%. So the criteria is more than 10%. If that more than 10% somebody is holding, then whatever the subsidiary which comes under that will be part of step-down subsidiary of the parent entity. For example, in this case, Y company, they are holding 51% Y company. If Y company holds 9% in Germany, okay, then continue. Germany holds 15% in Singapore. Singapore holds 15% in India, then it is allowed, because our structure stops UK itself. Our structure stops UK itself because UK does not hold more than 10% in Germany. So which does not have control on Germany entity, what they can do, what they cannot do. Okay. So that we'll have to see. Control part is more important. Somebody is holding more than 10%, it is considered as control, and all responsibility OE regulation will be complied with respect to Indian entity. So energy strategic sector, there are certain strategic sector like energy, natural resources, etc. If any Indian entity which is into strategic sector, like who is involving in oil, gas, mineral, etc., if they wanted to invest in a foreign entity, then they will have to get permission from competent authority before making such investment in those sectors. This is foreign entity, okay. So a foreign entity which is into activity of exploring oil, gas, coal, mineral, etc., then any Indian company who want to invest in those sectors has to get approval from competent authority who is managing strategic sector in India, ministry approval. Swap of shares. So Indian company may issue capital equity to a person resident outside India under the automatic route. So this is nothing but swap of shares. I am an Indian entity, so I am going to purchase the foreign company shares. So instead of making payment to them, so what I am going to do, I will issue my own shares to non-resident and I will get the shares from them. So earlier it was not allowed cross-border transaction, cross-border swap of shares which is not allowed under automatic route. So now RBI liberalized that one. So if somebody wants to receive the foreign shares, instead of making remittance by way of swap of security, they are allowed to receive the foreign securities. So swap ratio to be captured in the valuation certificate. The valuation certificate to be obtained from merchant banker. No deferred payment in this case. Any of payment will not be happen actually. While reporting the transaction FCGPR, we will come to know when I am taking foreign direct investment. FCGPR normally whenever a company issues shares to non-resident, they are allowed to file form FCGPR within 30 days. Similarly, since the Indian company issuing shares, they are allowed to file form FCGPR, and they are receiving foreign company shares as well. So they are allowed to file form FC and get the UIN to the AD banker. Forms approval to be done. Valuation, as I mentioned, that it has to be SEBI registered merchant banker or investment banker. Only in case of swap of securities. For normal ODA transaction, it can come from CA, chartered accountant. Swap is not allowed only between Indian companies. Swap was not allowed with the foreign company shares. With the foreign company shares, which is not allowed. Our Indian company shares, they are allowed to swap between Indian company shares. Now they are given liberalization. You can swap with foreign company shares. Both FDA, ODA regulation will be complied for the transaction. No value cap, because when you are doing swap, ratio will be determined. How ratio will determine what is the valuation of the Indian company, what is the valuation of the foreign company. Okay, so how many shares you are going to issue? So what is the value for that? To the equivalent of that value, you will have to receive as a foreign securities. Because the money does not involve in this transaction, they wanted to ensure the valuation has to be done by category 1 merchant banker, which is SEBI registered. For normal other transaction, when entity wanted to make the remittance and purchase the shares, so that also valuation is required, but that valuation can be done by any chartered accountant. So prohibition, no person resident in India shall make in ODA only this particular sector, which is real estate activity, gambling in any form. So, and similarly there is no structure, more than 2 structures they cannot invest. So real estate, we'll have a separate definition for real estate. Real estate is only buying and selling of land or property, that only is considered as a real estate. If somebody want to invest at that particular foreign entity which is into construction activity, they are buying the land and they are constructing the premises and those will not be qualified as a real estate activity. So investment can be done in those foreign entity which is into construction and development of industrial or commercial unit for the purpose of, even for purpose of leasing or for the purpose of sale also fine. So only restriction is they cannot buy outright and sell outright. That is not allowed. Only those cases will qualify as a real estate activity. If they are construct and then they can sell it, that is allowed. So various types of financial commitment. Financial commitment, we say that ODI and OPI both will qualify as a financial commitment. So any entities, how much they can allow to make remittance is 400%. We seen earlier that when listed Indian company want to invest listed foreign entity, then the net worth, that the limit is 50% of the net worth. Now when a company which is investing into unlisted company, then it is a 400% of the net worth. They can invest up to 400% of the net worth, up to 4 times of the net worth of the latest audited balance sheet. The audited balance sheet is the not exceeding 18 months on the date of remittance. And who can, they also lend, okay. Financial commitment includes equity, loan and guarantee. Okay, all these considered as a financial commitment. Whatever the remittances or whatever the financial commitment made, all these put together should not exceed more than 400%. And now debt instruments, who can give allow? Now the Indian entity, assuming the Indian entity has invested into the foreign entity and acquired the shares. Now they wanted to give loan to the foreign entity. They wanted to give loan to the subsidiary. So that also will qualify under the OI regulation. So how much they can make? Same 400%. They will have to make a loan agreement and the interest rate should be on arm's length basis. Though they are giving the loan to their own subsidiary, but whatever the interest rate charged should be on arm's length basis as if the loan has been given to third party. So who can give loan? Somebody, whoever is holding more than 10% or whoever is holding control in the foreign entity, only they are allowed to give loan into the foreign entity. Assuming an Indian entity was invested only 9% in a foreign entity without having control, they are not allowed to give loan to the entity. Okay, the main condition would be, the first condition is the equity investment should have been already made. Not directly loan cannot be given. First remittance should be equity. The first condition is equity has been already made. Second condition is they are already holding more than 10% and having control. Then only they are allowed to give both loan and as well as guarantee. Okay, guarantee also can be given. So guarantee, what kind of guarantee? Corporate and performance guarantee by Indian party. By group sister company also can give guarantee. Personal guarantee of the promoter of the Indian entity can also give. One SPLC issued by bank. So all these guarantee will part of financial commitment, which includes 400% of the net worth of the Indian entity. For this guarantee can be given to foreign entity or their stepped down subsidiary as well, where Indian party is having control in it. Group company guarantee, if a group company is giving the guarantee, so that particular amount limit would be included in the group country 400% net worth. It's not the Indian party. Assuming there is an Indian party who has made the ODA remittance equity, an associate company of the Indian company who wanted to give guarantee for the only one subsidiary who is borrowing money from abroad. So if group company is giving the guarantee, this 400% net worth, they will have to comply for their particular thing, whether it is including 400%, we need to obtain SA certificate from that group company, whether they are in compliance with 400% net worth before giving the guarantee. If it is any personal guarantee given by promoter or director of the Indian company, then that particular thing will be included in the Indian company financial commitment. Okay, that is not corporate guarantee given by Indian company. The corporate guarantee in the form of personal guarantee which is given by director or promoter, then also the limit would be included, added to the Indian company limit and to arrive 400% net worth.
There are common directors, promoters between the group
No, if it's a resident, whatever the if it's a resident, then it is allowed. So if non-resident giving a guarantee, that
In the resident category,
Huh?
you said if the group company is going to give a guarantee to the foreign company,
correct.
where another group company is only invested, that equity.
Now Indian company is invested, correct?
Yeah. And the group company in India is going to give that guarantee.
Correct.
And you said even the directors who are going to give a
No,
personal
that is separate. The first is group company. Okay. First is group company. If group company is giving guarantee, then we'll have to see whether 400% of the group company net worth is complied. Okay. You forget, now that is completed. Now individual is giving personal guarantee. Okay. When individual is giving personal guarantee, then Indian company who has invested, whose financial commitment will be included, and 400% net worth of Indian company will be calculated.
And the group company also will be taken because he is the director.
Group company, no, group company only if they are giving from their Indian, that company perspective. The personal guarantee will be individual capacity only they are giving. Group company is giving corporate guarantee given by another Indian entity. Okay, this is personal guarantee will be included in Indian company financial commitment. If it's given by group company by way of corporate guarantee, then it will be included in their financial commitment, 400% net worth. So performance guarantee also will be given as a guarantee, but 50% of the performance guarantee only will be accumulated for the purpose of financial commitment, not 100%. Creation of charge on the domestic and foreign asset. So Indian company, so we have already seen that equity loan guarantee will be part of financial commitment, and over and above pledge of asset which also be classified as a financial commitment. Assuming there is a foreign entity who has acquired the loan from a foreign banker, Indian entity who is having control in foreign entity, that bank has, that foreign entity is acquiring loan from foreign entity, okay, foreign bank. That bank wanted Indian company shares to be pledged because parent company is in India, so they want Indian company shares to be pledged. So if even for that is allowed under automatic route, we'll have to give NOC, they'll have to approach to AD banker and get the NOC, and we will see what is the value which they have taken the loan. Okay, that will be considered as a financial commitment and will be added to Indian entity before giving their shares for pledging. So there are various scenarios under which the loans can be given. So these are the second, because IP may create charge on overseas asset for domestic lender, and also they can create charge on domestic asset in favor of both. In both the cases, the financial commitment will be included of an Indian party. So document, these are the main documents which is required for making remittance. Form FC section A to D. A is details of Indian party, B is details of foreign party, and C is nature of method of investment, and D is declaration. As I said, declaration, there are 4 declarations which will be given. Normally first is there anything to be regularized to be reporting, any investigation agency, LRS limit is not exceeding 2,50,000. So there are certain 4-5 declaration has to be given. Bank specific declaration, bank also, each and every bank will ask for specific declaration. Form A2, FEMA declaration, so any outward remittance which is to be supported by Form A2. Valuation certificate, so valuation certificate which is not required in case of newly formed entity, which is the payment is made towards subscription to MOA, otherwise valuation is required. So constitutional document of foreign entity and Indian entity. So we'll have to see the constitutional document of the foreign entity, what is the activity of the foreign entity, whether it is allowed or not allowed, etc. So UIN need to be generated online. So once the document has been given to the AD banker, AD bank will generate UIN and give it to the client. This is the section which we already discussed. And third is Annexure 2 is annual performance report. We will discuss later, and Form OPA. So obligations. So now remittance has been made. What are the obligations for Indian entity? Shares to be allotted by the foreign entity and share certificate to be obtained or given within 180 days to the AD banker. So they will have to obtain within share certificate within 6 months from the date of remittance. And registered partnership, registered LLP, the individual may hold shares on behalf of the firm in the overseas entity. If LLP is being making remittance, the shares can be allotted in the name of individual partner as well. Form FC should be submitted along with requested document UIN. Okay. All ODA transactions should be done through the same AD bank. Assuming the client has done forming a Singapore subsidiary and he is approached SEB, so all subsequent remittances has to be made through that bank only. They cannot make through other banks. So other bank may not consider or they will not entertain to make the transaction. The first question they will ask, where is the UIN? Then they will ask that who is the bank through you obtain the UIN. So all remittances has to be made through that bank only. And realized repatriate dues, all dues, any dues which is receivable should be received within 3 months from the date of its due. Assuming if there is a dividend has been declared, or if there is a loan has been given and interest to be received, all those things has to be received within 3 months from the date of due.
Sir, this rule apply to NRI, sir?
This applies to, that is separate thing. These rules apply for those who are giving made investment outside India.
Whether it apply to resident or non-resident also, NRIs.
NRI, so.
It not apply.
See, NRI investing outside India, I was telling, no?
Yes, sir.
NRI investing outside India, FEMA doesn't come into picture. See, non-resident investing in a foreign company, FEMA doesn't come into picture. It's similar to resident is doing a resident transaction. So, non-resident doing transaction with a non-resident company, no FEMA regulation would be applicable. Non-resident doing a transaction with a resident company, then FEMA would be applicable.
Even if he is a non-resident Indian, NRI, I am just asking about NRI. If he is Indian, this will not apply.
No, NRI is a NRI. There's no, see, there is only two categories, one is resident, another is non-resident. Okay, all this applicable only to resident. Okay. Non-resident include NRI. So pricing guidelines needs to be applied earlier, no? So in FDA there is a separate category of pricing guidelines. In ODA, the responsibility which they are given, the delegation which they are given to the AD banker. So now RBS does not provide any provision with respect to pricing guidelines. They said each bank you formulate a policy which has to be approved by your board, then you can do it accordingly. So normally pricing guidelines is nothing but we need to obtain a CA valuation certificate on the foreign entity, and as per that the payment has to be made to purchase the shares. In FDA regulation there is very clear cut regulation which has given that the price should not be less than the price certified by CA. If any Indian company want to allot the shares to the non-resident, they will have to obtain CA certificate. If CA is given the valuation of 20 rupees, so at any point the shares cannot be allotted less than 20. It has to be more than 20 as per FDA regulation. But in OD regulation, that particular thing which is not given, that they are given to individual AD bank, you formulate your own policy and decide accordingly. Some of the banks might given 5% variation down or up, it's allowing. Some banks will stick to only 100%, only whatever the value which is being given by CA. So I will have to go by that only. Dollar, because it's a foreign company shares, it has to be in dollar only.
Sir, who will value foreign entities financials, sir? Who will value the foreign entity financials?
Overseas CPA or CA.
CS can do that.
CAs can do if they are eligible to conduct audit of foreign accounts. There is a special purpose, I don't know exactly because I was not aware. Some CA told me that they can audit under special purpose audit only for the purpose of giving APR, only for the purpose of ascertaining value, etc. But normally if you ask me, CA or CPA can be given. But valuation should be done on arm's length basis. So transfer or liquidation. So now I have invested already. So I want to transfer my investment either to another Indian company or to a non-resident. I wanted to come out of that. So that can be done, the transfer can be done, but you will have to wait at least 1 year before making such sale of shares. So today I have invested, I need to wait till next year. After completion of 1 year, I am allowed to sell shares of the foreign company to repatriate the money. So it has to be received within 30 days. They'll have to file one year. And in case of merger demerger, because of merger demerger amalgamation between one foreign entity and another foreign entity, because of that, if I'm going to sell the shares, that is allowed. You need not wait for 1 year. In case of merger, demerger, amalgamation, etc. But if you want to sell and get the money, then it has to be wait for minimum 1 year. So disinvestment including write-off, we spoke that write-off is under approval route earlier, now under automatic route. This also they have given the delegation power to the AD bank only. AD bank to formulate the policy, how you wanted to ensure that. Some banks, they used to take that financials of the foreign entity and see whether is there any amount which can be repatriable. By seeing the financials, if they are very sure that nothing can be repatriable, everything has to be write-off, then they may take action on that to allow the Indian party to file the disinvestment even with the write-off. That no fund is being remitted. Various sections, section G is to be fined within 30 days from the date of disinvestment. So investment approval route, earlier whatever we told in automatic route, approval route, if any investment which is being made in a financial year above USD 1 billion, which requires RB approval, even though that 1 billion is within the 400% of the net worth. Okay, initially we told that 400% net worth, that 400% net worth is capped up to USD 1 billion in a financial year. So that requires RB approval. Approval from central government in case of investment to be made in Pakistan. Okay. Similarly, Indian entity appearing NPA will put under investigation shall obtain NOC before making FC for undertaking disinvestment. This is the important one, where an Indian entity has already issued a guarantee before investigation has begun, or account is classified as NPA willful defaulter, subsequently is required to honor such control obligations, such remittances due to invocation will not constitute fresh financial commitment and hence NOC shall not be required. This is important thing. Assuming today I am giving a guarantee to on behalf of non-resident. Okay, the guarantee is a non-fund, may or may not happen in future. Okay, after down the line, 5 months down the line, I have been put it into NPA, or some cases were on me, okay, by which is pending with investigation agencies. After 1 year or 6 months, 7 months, there is a claim which is coming from overseas bank that your borrower is not paid the money, you pay me the money basis your guarantee given to us. So now, whether we'll have to wait for NOC to get before making remittance, the answer is no. Why no? When they are giving the guarantee itself, the financial commitment which has been already accounted for, the money which they are making is not a fresh financial commitment, it's a conversion from non-fund to fund-based. It's not added to a fresh financial commitment. Saving today, I am making 1 lakh USD dollar, which includes 400%. Tomorrow, against that 1 lakh only I am getting a claim. So I have already reported as a non-fund. Now I am not going to add that 1 lakh again. I am just going to convert that 1 lakh into 1 lakh, so that will not be constituted as a fresh financial commitment, and no NOC is required, even though at the time of remittance the client is into defaulter or investigated by the investigated agency. So approval route procedure, whatever they will have to get the board resolution for approval, and details of Indian entity, details of foreign entity, and which class they wanted to get seeking approval from Government of India, Reserve Bank of India. So all those things they will have to give and send it to Reserve Bank of India for approval. There are various schedules which is given under ODI. Schedule 1 is nothing but talks about investment, manner of investment being made by Indian entity. So how Indian entity, how much they can invest, etc. If Indian entity is into financial services activity, there is an additional point to be considered. When Indian entity is into financial services, when they are investing into financial services activity outside India, irrespective of whether the Indian entity is into financial or not, if an Indian entity want to invest a foreign entity which is into financial service activity, the main criteria is the Indian entity should have gained minimum 3 years profit, preceding profit for 3 years. So then only they are eligible to invest into a financial services activity. Second is the Indian entity should be registered with the regulatory authority if they are holding financial service activity. Similarly, the foreign entity also should have been obtained host country approval for doing financial services activity. Schedule 2 talks about OPI by Indian entity. We discussed that Indian listed entity can invest into overseas listed entity up to 50% of the net worth. But unlisted entity can make OPA only under the following circumstances, that is acquisition of equity capital by way of right issue or allotment of bonus issue, capitalization of dues amount due to Indian entity from foreign entity, swap of securities, merger, demerger, amalgamation, etc. So an unlisted company can acquire foreign listed company only by way of right issue, bonus issue, only by way of capitalization or swap of securities or merger, demerger, etc. They cannot simply make the money and acquire the foreign company share. That is not allowed. Oh. That is ODA. That is a normal ODA, whatever discussing. Overseas investment by resident individual. So resident individual is also allowed to invest in a foreign securities up to USD 250,000 per financial year. They can have only invested in operating entity. So Indian resident individual cannot invest into a financial services activity, and whether that particular foreign entity cannot have a subsidy under that. Okay. When resident individual is holding more than 10% in a foreign entity, that foreign entity cannot have subsidy under that. Not only in India, even outside country they cannot have. That particular 2-layer, 3-layer, whatever step-down subsidy is allowed only with respect to investment made by Indian entity. So also they can issue by way of swap of security, acquisition, equity, right, gift, inheritance. In all those cases, resident individuals are allowed to receive investment.
Floating a one-man company in UK, $1,000 or £2,000. Is it necessary for inform?
Correct. Under LRS, under ODA, we'll have to see whether that is unlisted or listed company. Private limited company, 100%, they will have to approach to the ready banker and obtain the UIN.
So not that within that $250,000.
No, it's written. First. Limit of LRS which is present at 250,000.
1,000 pounds is very much less than that. No?
Less than that. Still, this applicable is less than 250,000 only, they will have to approach to AD banker. More than 250,000, they will have to approach to RBI for approval. This AD bank under automatic route.
Sir, example in one case,
Ah.
in one case, what happens is the foreign company, which is the parent company of Indian company, they are giving ESOP to Indian employees.
Okay.
And that ESOP is done by a foreign administrator.
Yeah.
The third-party administrator.
Okay.
Through them, there is a wallet system through that they are crediting the units
Okay.
in terms of shares.
Okay.
Shares in terms of units.
Okay.
And if the value that is actually, that unit is now in the name of employee.
Okay.
Whenever the employee desires, after the vesting period, the employee can sell the units in the market in the US, then money can be realized in India.
Okay.
Now, if that value, because if it is a key managerial person, and if the value exceeds $250,000 then how that
This is only when the remittance is being made from India. Your question is when money is coming from outside India. Correct? Your question is sale of shares when money is coming from outside India.
No, here they are making ODA. It is like they are acquiring the shares of.
They are acquiring shares under ESOP. Okay, how much they are making payment?
No,
Is it cashless or cash?
the value of that units credited to this Indian
How much?
person is exceeding the 250,000 USD.
Okay.
Almost 2 crores, example in Indian rupees, 2.2 crores.
Okay. Okay. There is an exception for ESOP. Okay. There is an exception for ESOP. Resident individuals under ESOP, there is a different category. When we see in the earlier one, the resident individual is not allowed to invest in a financial services activity. the resident not allowed to invest in a foreign entity which is having control, which is having subsidy under that. Okay, that is the individual investing on their own. Okay, the same individuals who is acquiring shares by way of ESOP, same foreign company shares ESOP. If that foreign entity is having in a financial services, no problem. Okay, if that foreign entity is holding subsidiary, no problem. Exception was there. Okay, and that investment can exceed more than 2,50,000. Okay, but that will be calculated under LRS limit. Their limit will be blocked. They cannot utilize for any other purpose under LRS. So you know that LRS, under LRS, resident individuals are allowed to invest for any bona fide purpose, like for purchase of property, for making investment, or for paying tuition fees, or somebody staying in there for making their maintenance. For all put together, they are allowed to invest up to 2,50,000. Okay. In your case, assuming there are 3 lakhs worth ESOP has been given to Indian employee. Okay, he is allowed to make 2,50,000, 3 lakh payment. He is allowed to make $3 lakh against that ESOP. Okay, but his entire 2,50,000 will be blocked. Okay, he is only on exceptional cases he is allowed to make ESOP remittance by going to application and give $3 lakh. He'll have to make payment of 3 lakh, correct?
No, actually, in my case, it is a SBC, stock-based compensation, equity settled.
Yeah, stock-based compensation. How they are going to acquire the shares? How much? Who is?
There is no payment from the employee.
Why? Is it cashless scheme or cash scheme then? You said ESOP scheme. Yeah. Then how is going to acquire the shares?
The shares are getting credited to the account without any payment. There is no option for
That means it's a cashless scheme.
Yeah.
The ESOP scheme, there are 2 schemes. One is cash and another is cashless scheme. Cash scheme normally will be given, the share will be given on the discounted rate to the employee. Yes. Cashless scheme is they don't need to pay any amount, simply the amount will be credited. Okay. This 2,50,000, since in your case there is no money need to be paid by Indian employee, then where is the question of 2,50,000 is breached? Only are making payment. Only on making payment. Assuming in the same case they want to make payment 3 lakh to acquire the shares, then it is allowed.
Sir, regarding conversion of a loan to equity or foreign
Premises, initially there is only classification between one packet to another packet. Both are financial commitment. You already reported. Okay, initially you reported as a loan. Now you wanted to convert into equity. So you will have to make an agreement between parent and subsidiary that on a particular date I wanted to convert this loan into equity. So you will have to calculate value as on the date when you are converting. Foreign company value you will have to convert, and equivalent to number of shares you will have to give it to the client, I mean Indian company. So then they will have to report Form FC, they will have to report again Form FC, but there is no fresh financial commitment. Form FC to be given, and you will have to give the letter how many number of shares you are obtained and whether valuation has been complied. You will have to submit with valuation certificate. You will have to file with the Form FC, an agreement between investor and the parent.
conversion, I did not check my net worth criteria because already it is done.
You will have to report.
I will report,
Ah.
but my net worth criteria need not be checked.
No, need not be checked. Because there is no increase in the financial commitment. Need not to be checked.
Extending on this query on ESOPs,
Ah.
there is also other scheme where employees are allowed to buy the stocks of the US company. Under ESP, they call it as an employee.
Whatever scheme, whatever employee scheme.
That will fall under LRS, right?
Everything fall under LRS.
But the employees generally, they don't make any communication to RBI.
Ah.
They don't apply to the AD because they don't do it. Everything is done by the employers. Who takes
Employer. Okay, there are two ways the shares can be purchased. One, direct employee can directly make the payment and get the shares. Second is on payroll. Every month payment will be deducted, and employer will make payment on behalf of employee. When employer is making payment, they will have to give details of who are the employees, their PAN number and their amount, individual amount. So with that amount, bank will report it in the LRS. So that will be calculated under LRS limit only. It will be reported. Employer needs to give the details. The bank will ask. The moment employer says that this is employee contribution towards ESOP, Then the bank will ask for, please provide details of all your employees along with their PAN number and individual amount. Those details, once we obtain, we will have to report it in the LRS portal. So your the limit will be counted on that LRS.
But is there anything specific in law that says the onus is on the employer and not on the employee?
Onus on the employer. It's there, very clearly given. It's there. It's there. It is a, even if the employee is making, it is the employer responsibility to file form OPA. The form OPA needs to be filed whenever any employee is allotting shares of ESOP or any remittance is being made against ESOP. The employer needs to file form OPA within 60 days from the closure of the half-yearly. So it's a half-yearly reporting, April to September and October to March. So the due date is before 60 days from the closure of that period. So that is the responsibility of the employer. Even the bank will ask, whenever employee themselves is going and remitting, then the bank will ask, you get the declaration from your employer stating they will report OPA within 60 days, all those things. No, this is not firms portal. This is ODA portal. This is ODA. Firms is FC. This will be applicable only on FDA. So this they need to intimate to the AD banker. That's the form. OPA is a physical form as of now. It's a 2-page, 3-page form. They will have to fill it and submit with the AD banker. Various other investment can be made by trust, society, other entities, etc., subject to SEBI approval and other regulatory approval. Mutual fund also, SEBI approval. Overseas investment in IFSC. So IFSC will be considered as a country outside India. So any investment which is being made to IFSC, any company in IFSC will be considered as an ODA. If it is an unlisted, if it is invested in a fund or mutual fund, etc., that will be considered as OPA. So individuals are allowed to invest not only outside country, they are allowed to invest in IFSC, Gujarat city, where they can allow to invest. Reporting formalities, they will have to file APR before 31st before 31st December. So annual performance report, nothing but performance of the overseas entity. An Indian entity has invested money. So RBI wanted to see what is the performance of the overseas entity, how much they are making profit, how much they are given dividend, how net worth is, how reserve and surplus, etc. So it's a simple form which has to be given by the client with an audited financials of the overseas entity. So audited finance is mandatory when somebody is having control in the foreign entity, irrespective of whether host country regulation does not require the accounts needs to be audited. So as per our regulation, irrespective of whether host country regulation is mandatorily auditing the accounts or not, as per our regulation, if somebody is holding more than 10%, then it has to be audited and it has to be filed along with audited financials only. Foreign CPA, that's what, again the same question, whether Indian CA is allowed to audit foreign company accounts. That is something, I got the different answers saying that special purpose audit they can audit, or somebody is holding CPA certificate, they can audit. So it depends. So there are certain timelines, everything needs to be completed within 30 days, etc. Delay in reporting, this is one of the important relaxation which is given. Earlier, whatever be the compounding contravention, non-compliances has to be compounded by the Indian entity. Now, there is an option which is given to the Indian entities and resident individuals wherever you made any delayed reporting earlier, assuming you have done 10 years investment, in one of the year you have delayed reporting the APR. APR needs to be reported before 31st December. You reported 1 month later, okay. So that point of time still it is a non-compliance. So RBI said that whatever you have not reported or which you reported with a delay, you go and approach with your AD banker and regularize it by paying simple payment, then you will be out of that non-contravention. You will be out of that non-compliance. So that provision which they are given 3 years timelines, this was issued in 22nd August 2022. So whatever non-compliances, whatever delayed filing which has done prior to 2022 August, they given 3 years time before you make the payment LSF. That is going to be expired another 4 months, within 4 months time. So 22nd August 2025 is the last day wherever Indian entity is not reported any transaction or delayed reporting, that has to be regularized. If that day crosses, if they don't, if they are having some delayed reporting which has not been regularized, then compounding procedure will be applicable. Regulation 12, one of the main important regulation is no further financial commitment, whether fund based or non-fund based, if any Indian entity's delayed reporting is not yet regularized. Okay, assuming I have invested in a foreign entity, but I have not received the share certificate which is exceeded 6 months. Okay, I received the share certificate, assuming I invested 2 years back, 2022 I have invested, and 2023 I got the share certificate of the investment. Okay, now I wanted to make additional investment. As per the regulation, share certificate should have been submitted within 6 months. Okay, now AD Bank will see when this client has submitted share certificate. They know this client has submitted share certificate after 1 year. Okay, so there is a delay in submitting the share certificate. So it has to be regularized. So in the meantime, they are coming up for additional payment. So bank will not allow them to make the payment. You first regularize that by paying to 7,500 by giving an application and making the payment of LSF 7,500. Then only the AD Bank will allow to further invest into that foreign entity. And if it is amount based, then there is a calculation 0.025% with the amount and with the number of years delay. But if it is a non-fund reporting like APR, share certificate, etc., it's a flat 7,500. The normal deficiency which we found at the bank end, that there are various discrepancy which we could able to see when client is filing the document. We go through second important thing is foreign investment in FEMA, that means foreign direct investment. This is nothing but opposite to ODA. ODA is where Indian entity is investing outside India. This is where foreign company is investing into India. So similar to OPI, ODA, there is an FDI, FPI, foreign direct investment and foreign portfolio investment. So these are the regulations which is governed by non-debt instrument rules. Mode of payment and reporting non-debt instrument rule, plus note 3, which is an important PN3, famously called Master Direction Foreign Investment in India, and FAQ1 FDI. So foreign direct investment is investment through equity instrument by a person resident outside India in an unlisted Indian entity. So similar to what ODA, if any investment which is made in unlisted entity by a foreign entity, that will called an foreign direct investment, or 10% of more in a listed entity. So up to 10% investment made by a foreign portfolio investor, that is qualified as a foreign portfolio investment. If anyone is holding more than 10%, then automatically that will qualify as foreign direct investment. Foreign portfolio investment is normally investment to be made in a listed entity. There is a foreign portfolio investor who used to register with the SEBI regulations, SEBI authority, and got the approval to invest in a listed company into India. So this includes FII, foreign institutional investor, and foreign NRI as well. So they are also allowed to invest up to 10% under OPA. If it is beyond 10%, then it will be a FDI transaction. So normal route is automatic and approval route. Automatic is no prior approval is required. Approval means not RBI approval, it's approval from Government of India. So this FDI is governed by FDA policy, foreign direct investment policy, which is been decided by Government of India. Not only reporting per se, RBI is there to facilitate reporting. Otherwise, for all the regulation rules has been given by ministry. So any approval means which required Government of India approval. So for getting a Government of India approval, the company expecting FDI, okay. So they will have to approach Foreign Investment Facilitation Portal. That is the portal which normally gives approval to the company. So they will have to go as per that, and detail needs to be filled in, form needs to be filled in, and based that application can be submitted to Government of India. press note 3, PN 3, so which is issued on 17th April 2020. So prior to that, a non-resident entity can invest in India under automatic route. Only with respect to Pakistan, it has to go under approval route, government approval route. So then in 17th April 2020, RBI issued expansion of that approval, saying that any country which is sharing land border with India, so any investment which is coming from the country which is sharing land border with India, then that also requires prior Government of India approval. So basically it's not only China, there was some China occupancy which was more. So instead of targeting only China, they said that whichever country which is sharing land border, which has to be getting Government of India approval. So currently the list of countries which is sharing land border is Pakistan, Afghanistan, China. China includes Hong Kong and Macau, Nepal, Bhutan, Bangladesh, Myanmar. So any investment which is coming from these countries which requires Government of India approval. So if you see in this, Sri Lanka may not be there because Sri Lanka is not sharing land with India. There are only sea border, sea only is connecting with India. So significant beneficial owner. So in that particular investment, press note 3, it's not only the country which is sharing land border with India. If any investment which is coming from outside these countries, whose beneficial owner which is situated in this particular country, then also it is not allowed. Beneficial owner normally is somebody is holding more than 10% or having control in the company, they are also not allowed to invest. Assuming there is a Singapore entity. Singapore entity wants to invest in India. Okay, that is normally allowed under FDI, there was no restriction at all. If the Singapore entity is held by a Chinese entity, the Chinese entity is holding 50% or holding 15% in that Singapore entity, then we'll have to see who is the beneficial owner of the Singapore entity, and we have found that one of the partner, one of the shareholder is Chinese entity and who is holding more than 10%, then that also requires Government of India approval. So not only the direct investor, but beneficial owners of the investor also should not be falls under the land border countries. If so, they require RBI approval. Individual. Individual resident or non-resident?
Resident, and subsequently he goes to any country which has land border, and from there he infuses additional capital in that Indian entity. Even in that case, this person agrees.
See, whatever is holding, but is the national of India or national of that country?
National of India.
National of India does not allow, it's NRI. National of those country. Citizenship of those country. Only that is allowed.
So in that Singapore entity which is having investment in India, it is making investment in India.
Which entity?
Singapore entity.
Ah.
Singapore entity is owned by a Chinese national. In that case, it is an approval.
Correct, approval route.
Chinese individual.
In Chinese national or entity, whichever. After investment also it has to go under approval route only. See, at the time of investment, assuming at the time of investment, Chinese is holding 8%. So now we come to know that there is no BO involvement. Okay. So the investment has been received. After 1 year, the Chinese entity is acquiring 3% from another shareholder outside country. Now it's become 11%. But still that requires our Government of India approval. That Indian entity has to know everything what is happening into the investor company. So before the Chinese parties acquiring shares, that time itself they need to approach to Government of India to get the approval to acquiring 3% of the shares. So this particular beneficial ownership is not only at the time of making remittance, even after making the remittance also. That significant ownership has to be less than 10%. Yeah, initial automatic route because the Chinese entity is holding only 8%. Okay. The moment the Chinese entity want to increase the stake more than 10%, before acquiring, they need to go and approach with Government of India for approval. Because one of one of the shareholder who is currently holding 8% want to increase 3%. If they increase, then this company will breach the Prasno 3 regulation. They will have to get the approval. Non-controversial, nobody knows. See, the question here is nobody knows what is happening outside country. Okay. FEMA normally comes only when some investigation happening on that country. Otherwise, nobody knows. If even in our country, there are a lot of FEMA non-compliances still will be there. Okay. Unless somebody searching, unless somebody questioning, somebody come to know the transaction, then only they know. But still, the company is in verge of contravention of the FEMA. The company should aware of that one. They have to go, someday they have to go and inform to Reserve Bank of India, Government of India to get the post facto approval or pre facto approval, whatever thing. Something which has happened, they will have to go and approach to the Government of India to get the approval. So, Government of India at that point of time, they might say you exit the investment from Singapore. The maximum what they can do, Singapore entity has invested, no? You close that entity, you give back the money, don't allow them to continue in your shareholders. But it has to be reported to them. Otherwise, the non-contravention will be on the Indian company side only. So prohibited sector, similar to FD, ODA, there are various sector is under prohibited: lottery, gambling, chit fund, nidhi, manufacturing and cigar, cheroot, etc. So any investment cannot come into activity which is assuming ITC, Indian Tobacco Company, they cannot receive FDI from outside country because that is a restricted one. Manner of receipt of funds, FDI. So how the funds can be received? Inward remittance through Nostro, debit to NRE and FCNR account. If investment is coming from NRI individual, so money can be received from NRE account or FCNRB account. Debit to non-interest bearing escrow account in INR. So funds cannot be received from exchange house, and funds cannot be received by way of cash. Sometimes what we have seen that NRIs come to India for a business visit and he given the cash to Indian company to acquire the shares. So cash is not permissible method of investment to acquire Indian company shares. Mode of investment, so subscription to MOA, preferential allotment, right issue, bonus issue, swap of shares, merger, demerger, conversion. So all these cases, the shares can be purchased by non-resident of Indian company shares. So equity instrument is equity shares including partly paid shares, share warrant, compulsory convertible preference shares and compulsory convertible debentures. So all these constitute equity instrument, so which will be qualified as an equity capital of the Indian entity. The foreign investor can make the remittance. So similar to ODA, real estate business means dealing in land and immovable property with a view to earning profit therefrom, which does not include development of township, construction of residential commercial property. So real estate, here also real estate is restricted one, but if Indian entity which is into construction or development of a township, etc., they are allowed to receive FDI from non-resident individual. Real estate broking will be excluded because they are not doing buying and selling of property, they are just doing advisory services, so that is under automatic route, broking services. Partly paid shares have issued person should be within 12 months, it has to be fully paid. So minimum 25% has to be received upfront and balance can be received within 12 months. So partly paid of CCPS and CCDs are not allowed. Partly paid is allowed only on equity shares. Partly paid CCPS and CCDs are not allowed. Sectoral cap, one of the main important thing is sector. There are certain sectors which is completely prohibited. There are certain sectors up to certain limit, the foreign direct investment can under automatic route. Beyond that, it will go under approval route. So basis this sector, basis the pricing guidelines and other parameters, whether the Indian company needs to ensure whether they are eligible to receive FDI or not.
Sectoral cap is applicable even for listed entity. Is applicable for listed entity also.
Listed entity will be goes under the foreign portfolio investment, no, that is.
But the sectoral cap is still applicable for them.
Yeah, see, for them it's a separate category because they cannot invest more than 24% at a lot through stock exchange. Through stock exchange, first they need to register with SEBI to invest in stock exchange, okay. And how much they can invest, there is a cap which is given. not sectoral cap of that. Individual person, entity level, there was a restriction. A listed company.
There's a telecom industry. This, the shares are traded in the National Stock Exchange. NRIs want to purchase. So who will monitor the sectoral cap?
That will be automatically given, the report will be given to the Reserve Bank of India by the authorized dealer bank in India. See, this foreign portfolio investment will be made through an account in India, okay, of a non-resident. Non-resident will have SNRR account in India or foreign portfolio account in India, which will be denominated in INR, or non-resident individual will hold an account. So every day transaction which is doing purchase and sell, that will be reported by respect to AD Bank to Reserve Bank of India by evening 4 o'clock, 5 o'clock. After closure of market hours, every reporting with the security will be goes to Reserve Bank of India by way of online portal. With that report only, you can see the market that FII sold this much amount. All those things will be populated because of this getting details from this individual bank. And with respect to FPI, this is applicable both for listed and unlisted. That will be monitored by SEBI.
But not by the individual. Individual will not.
Individual restriction will be there only up to 5%. Only 5% they can invest. This broker might be knowing. Our reporting will be known. That's auto-populated. Everything will be known actually. The moment it is breached, then immediately SEBI will bar that investment to be received in the Takari. Normally, unless small investment will not be breached. Only if it is a bigger FII is going to buy the shares, then only the percentage will increase. So that point of immediately they will bar. You can see them news also, Kotak Bank has breached FII limit, so they stopped trading, etc. They will give always. So that monitor is happening systematically.
If it is from NRO account, then again sectoral cap will not apply.
NRO, okay. If you see that method of investment, I mention NRE or FCNR, okay. NRO remittance received from NRO for the purpose of investment, that will be treated at par with a resident investment. Okay. How resident investment is being made, whereas no compliance is required. Similar to the NRO will be treated as, it will not be treated as foreign investment, that will be treated as domestic investment. So the difference between domestic and foreign is the NRE can repatriate the funds at the time of selling the shares, wherein NRO cannot repatriate the funds. It has to be credited only to their NRO account.
Then again this LRS will apply.
No, NRO ka separate regulation USD 1 million, not LRS. LRS is 250,000 in a financial year. For NRO, they can remit up to USD 1 million in a financial year for sale of shares for any purpose outside India.
An NRI can give any amount of gift to another NRI or funds in India, right? From one NRI account, money can be given to the another NRO relative account, right? Can that person receive the gift, repatriate that funds under the $1 million limit? The money is received as a gift, can that person repatriate that under the $1 million limit?
Now first, we will have to see what is the permissible credit and debit of NRO account. Okay.
Let's say father to son, for example.
Okay.
Father is given
No, sometimes what happen, I will tell you one typical example, okay. There is a limit of 1 million applicable for NRO, okay. NRO is currently holding 15 crores in his account. 15 crores. If he is making remittance, he can remit 8 crores now or 9 crores now, balance 7 crores, you need to wait for next year. You see, so what they propose to do, they wanted to give it to the son. Son is also NRO. The son doesn't have any balance. So they will also send the money, no. So I don't know exactly, the case needs to be adhered because he is violating the FEMA of exceeding 1 lakh, he is getting a route of giving it to someone close relative as a gift to make the remittance to outside country. That we will have to see. There are certain permissible debit and though the transactions happening between two NROs, there are certain permissible debit and credit which is given in NRO regulation. We will have to see whether that is permissible or not. Third party NRO to NRO is not allowed. If you are having your own NRO, you can transfer to, if you are holding an account, NRO account with SCB, also holding ICICI Bank, you can transfer between these two NRO accounts. But other than your own NRO account, no other person NRO can transfer the money.
But that language is actually not very clear. If you look at actually the regulation,
It's not very clear, but with my example which I given, there is a possibility to overlook the FEMA compliance. If, assuming he's holding 25 crores, he can distribute 8 crores to son, 8 crores to daughter, and ask them make the remittance outside country. Then from there he will get the money.
No, actually, the person had done it when he was a resident, it was permitted. Let's say when both, let's say father, son, daughter, all three were residents. Let's say the father gifted money to daughter and son, so it was permitted. Then as
Both are
non-resident,
permitted, all are permitted with an individual level of 2,50,000. All are permitted.
three are residents.
Also, all 3 are resident.
No limit, right?
No limit. They are allowed to remit at the individual capacity 2,50,000. There is a source of fund. We'll have to see. Okay, source of fund, it should be their own funds. That is number one. The source of funds of LRS should be their own funds. You cannot borrow the money to make the investment.
You cannot borrow, but gift can be used by LRS also. LRS, I don't know, father gives to, this LRS limit is available even for minor.
LRS available for minor also. I completely agree with your point. But NRO gift, I am not sure whether transfer from gift to one person to another person is allowed or not allowed. We cannot take it as a grantor to overlook this one, because you never know when RBI will come back and say that where it is written it is allowed.
So another question, practically what is the best way to get this checked with RBI?
Which-
Because again, if you want to really check this with RBI, let's say genuinely a person wants to give money to this.
Genuinely want to give the money, you can approach your AD bankers. Okay, then let AD banker, you give the actual scenario, because RBI will never entertain with proposed transaction or with a no-name basis. They will not entertain. Okay, if the client is holding an account, if they genuinely want to transfer the fund, let them put the representation through the AD banker. Then let the AD bank approach to RBI and get the answer for that. You offline, you get the answer from RBI. RBI will never entertain. Even banks also never entertain. If it is actual transaction, you put up the case with your AD banker. Definitely AD bank will approach with the RBI to get the solution for that, whether it is allowed or not allowed.
But generally, on a practical basis, is RBI permitting any transfers in excess of 1 million?
They are permitting. They are permitting. See, there is an automatic route, approval route. So approval, definitely seeing the case of the merit of the case, if genuinely the money is required for medical purposes, assuming there is an operation which is going to happen, so you have to make the money, you have the money in India, but you don't have the, you have to send, when you are sending that much amount, 8 crores, which does not sufficient for them to treat that treatment, then you have to request RBI. They will give, depends upon the end use of the fund which you are going to make. That is more matters actually.
It's just a situation where the children maybe have non-Indian citizens. They just want to live outside India. So
That's whatever way, that depends on case-to-case basis. RBI might say, why do you require entire amount to be taken? I given 1 million. No, you spend 1 million next 1 year. After that, again you send another 1 million. The usage of fund, how urgent see the usage of fund to require the RBI approval to make entire amount to take away.
will it depend on the officer looking at the case? Or is it like a general SOP will charge?
No, there is no SOP. They will discuss among colleague of RBI, then they will decide. Before that, they will ask a number of questions. What is the utilization? They will put question, why you require entire money to be repatriated now? What will happen if they don't repatriate now? All those things will be there. Somebody is there, very aged one, okay, very old one, is going to die. We never know. It's a better, actually he is having 10 crores. You can't wait, ask him to wait till next year, no? Or next year. So those cases, depends upon case to case basis.
So just one last question on this. Let's say once we apply, RBI rejects it. We can also
That's it.
apply after some time, right?
You can't apply it again. Once rejected. Once rejected, we'll have to see what basis they rejected. Okay, you can't reapproach again with the same reason.
Actually, one case where one of my client, they are actually planning to sell their property which is worth around 15 crores in India, and their son is an NRI who's located outside India. So he wants to give that money to the NRO account of the son, and NRO account he wants to take it to this NRI account, or he wants to take it to repatriate outside India to buy a property there in his son's name. So whether that is possible? Because they have to buy the property outside India.
Fine, they have to buy the property outside India, but is there any limit breached here? No, 1 million. 1 million is not reaching. No, as long as you are sending money up to 1 million and buying the property, that is fine outside India. So startup ke liye there is a separate dispensation. They are allowed to issue convertible note. So convertible note can be issued only by startup, which is initially will be treated as debt, and over a period of time, within 10 years, that can be converted into equity shares or can be repaid by the startup. So that is one of the main facility which is given to startup. And the minimum amount they for each tranche they have to receive minimum 25 lakhs against each tranche. They will have to report. Similar to FCGPR, there is a form CN needs to be reported for issuing convertible note. Downstream investment is an Indian entity which is fully controlled by a foreign entity. Fully controlled means more than 51% held by a foreign entity or less than 50% held by resident. So both cases that will be qualified as an FOCC. A foreign entity which has created a subsidiary in India, that means Indian entity, which that Indian entity wanted to invest further Indian entity, then it is called downstream investment, because the initial entity which holds more than 51%, then this is qualified as a downstream investment. And any investment which is being made by this entity also subject to sectoral cap, pricing guidelines, all would be applicable. Even though the transaction is happening between two resident entities, the general principle is what directly cannot be done, which cannot be done indirectly also. Okay, assuming a foreign entity cannot be directly invested into a cigar company. Assuming a cigarette company fully prohibited sector. Okay, what they are investing is there is an investment of manufacturing. So they are investing into manufacturing and holding 100% subsidy. If that manufacturing in that entity wanted to invest into cigarette industry. Okay. So the general principle, what directly they are not allowed to invest, but here they are indirectly allowing. So that is not allowed. So whatever the direct principle, sectoral cap, pricing guidelines, all those which is applicable, which is same applicable when Indian entity is investing into another Indian company. Okay. That is main thing. There is a reporting which has to be filed. They will have to report it DIPP portal as well within 30 days from the date of investment. Similarly, they will have to file Form DI with the AD Bank within 30 days from the date of investment to be made in further Indian entity. So, onus on reporting is on the FOCC, the first level Indian entity. This is a Schedule 1, Schedule 2, Schedule 3. Schedule 1 is Indian company may issue. This is normal. Schedule 1 is any Indian entity, any unlisted company who is investing, who is getting investment from outside country. So the normal timelines is they have to allot within 60 days. The date of allotment has to be done within 60 days from the date of receipt of funds, and form FCGPR to be filed within 30 days. And there are certain documents needs to be attached along with FCGPR. This bill provides for payment of dividend and swap of securities also allowed. Entry route, sectoral caps, so as we discussed already, pricing guidelines is nothing but we need to obtain share certificate from chartered accountant and see whether the issue price should not be less than the price certified by CA. Which one, LLP? If LLP receives money, so they don't need to file because they are not giving shares to the non-resident investor. They are giving profit interest only they are giving to the investor. So that is also considered as foreign investment, but that will not be foreign direct investment. So foreign investment, foreign direct investment. So foreign investment that will qualify as a foreign investment, and they will have to subject to same sectoral cap, pricing guidelines, everything has to be complied. But instead of reporting form FCGPR, they will have to report form LLP1 within 30 days from the date of receipt of funds. There is no question of allotment of shares over there in LLP. So as soon as they receive the money, within 30 days, they will have to file form LLP1 with Reserve Bank of India. But all sectoral cap, everything will be complied by the Indian LLP. Schedule 2 is foreign portfolio investment, investment in a listed company. So holding each FPI should not be less than 10%. Schedule 3, investment by NRI on repatriation basis. NRI repatriation basis, they can allow to purchase listed company shares up to 5%. 5%, they should not exceed more than 5%. There are some, is subject to SEBI approval. So they can have an account with the AD banker and route all the transaction through their banker. Same schedule 4 is investment by NRI and non-repatriation basis. That is in repatriation basis, this is non-repatriation basis. Non-repatriation basis also they are allowed to invest, from their NRO account as well. This other kind of investment which is to be made in endowment fund, insurance fund, pension fund, etc. So foreign fund also allowed to invest in securities, listed securities, which is prescribed by SEBI. Like they are allowed to invest in mutual fund, they are allowed to invest in other alternate investment fund, etc. Investment in limited liability partnership. Only we said that activity 100% automatic route. Investment in LLP is subject to compliance with the limited liability. Pricing guidelines will apply for both investment and disinvestment. This is foreign venture capital investment. This is all method of investment where they can able to invest, and all these regulations, guidelines have been given with respect to that. So normal documentation, what bank will look into that whenever they are receiving any FDI remittances, bank specific FDI declaration. FDI declaration will have their own format by each bank, which covering what is the activity of the Indian entity, whether it is automatic or approval route, etc. Press-note 3 declaration, nothing but that they are beneficial owner or they are not into land border countries. So that declaration we will be obtaining from Indian entity. Copy of government approval if applicable. If any of the remittances which is received wherein the Indian entity which has to get government of India approval, then we will ask for approval copy. 6-pointer KYC of the investor remitter. This is more important thing. So RBI said that any investment which is from outside India, it has to be complied with 6-pointer KYC. We will see what are those 6-pointer. Investors other than remitter. The investment can be received from other than the investor as well. But the only thing is we'll have to receive KYC for both investor and remitter. And also we'll have to get a letter from remitter that why he is making payment on behalf of the investor, and he'll have to give NOC to allot the shares to the investor name. Similarly, we'll have to see get the investor letter also why the investment being made by third party. This is the KYC format. Normally registered name of the remitter, registration number, registered address, name of the remitting bank, bank account number, and period of banking relationship. This is a basic 6-point KYC will have to be received for every investment which is received from outside country. Pricing guidelines, we told that issue by shares by transfer of shares from resident to non-resident. If any Indian company who is issuing shares to foreign company, then the price should be more than the price, should not be less than the price certified by CA. If CA is certifying 50, then shares should not be allotted less than 50. It has to be 50 or more than 50. Transfer of shares from non-resident to resident. If non-resident is already invested, if now he is transferring the shares to resident, then we'll have to see that we'll have to obtain the CA valuation, and the price should not be less than the price certified by CA. So should not be more than the price certified by CA. So whichever way, the resident should be the beneficial. Okay. Now presently non-resident is holding, assuming the share price is 100 rupees. So non-resident cannot get more than 100. He can get 90, 95, even 100 he can get. He cannot get more than 100. This is the flow of transaction. A remitting bank will initiate MT199 of KYC, MT103. That will come to a receiver bank. Then receiver bank will get the FDI and investment declaration from Indian company. Then we will carry to customer account. Then we will issue FIRC and KYC, and they will have to file it in the firm's portal post allotment of shares. Reporting timelines, FCGPR, as I said earlier, 60 days they need to allow the shares, and 30 days they need to file the FCGPR. FCTRS is secondary transfer between resident to non-resident or non-resident to resident. That has to be filed within 60 days from the date of remittance or transfer, whichever is earlier. Form LLP1, investment received from non-resident into a limited liability company, then LLP has to be filed within 30 days. Disinvestment, if LLP partner is already invested, they wanted to come out of that LLP, then the Indian LLP has to file LLP2. So that reporting has to be made within 60 days. Yeah, valuation is required actually. They said valuation is required. I don't know how they are going to value LLP. Fair price, because for value the company share, there is a lot of methodology which has been given to arrive the value of the equity share of the Indian company. I don't know, but still RBI is getting, we are getting confirmation from CA that it is fair price of the fair value of the partnership from something they are giving. How they are valuing, actually I don't know exactly. Form CN to be required at the time of issuance transfer of convertible note. The startup can file LLP, CN. ESOP scheme. So when Indian company is allotting shares to non-resident, then they will have to file form ESOP. At the time grant of option, they will have to file form ESOP. At the time of conversion, they will have to file form FCGPR. So DRR report, domestic custodian shall report DRR within 30 days. Form DA and indirect investment, any FOCC, when they are investing into further Indian company, they need to file form DA. So an investment vehicle, similar to that, when they are receiving any fund, they will have to report it in the form INV. So all these form which is available in forms manual, forms portal, where this every reporting has to be made. In case if the shares have not been allotted within 60 days. So there is a time period under which the shares has to be allotted within 60 days. In case if the shares have not been allotted within 60 days, the fund has to be refunded within next 15 days. The total of 75 days, the fund has to be returned back. Late submission fees, similar to there, here also late submission fees is given. Any reporting where amount is not involving 7,500, this late reporting is applicable only late up to 3 years. If any late reporting which has done beyond 3 years, then that will go for compounding. FCGPR, FCTRS, all those which is related to amount involved, so 0.025% plus 7,500. 0.025% of the amount which is involved in the transaction into number of years which is delayed. Maximum LSF should be equal to more than 100, equal to 100% of the amount. You cannot penalize a client more than the amount which he has reported. Standard documents for FCGPR declaration, CA certificate, MOA in case of initial subscription, then board resolution, case to case basis in case of swap of securities, issue, right, etc. FIRs and KYC and valuation certificate. So valuation certificate should not be more than 90 days prior to the date of allotment. The valuation is not the valuation certificate date, it's valuation of the company date. This clarification which we have received last year. Prior to that, everybody is thinking of certificate is given by CA. So we used to look into 90 days from that CA certificate, but we got the clarification that the company needs to be valued not more than 90 days prior to the allotment. So for right issue only to be given to existing share. If it is given to existing shareholders, then is no valuation is applicable. If it is given to another non-resident basis the renunciation, then valuation is required and pricing guidelines needs to be complied. We have to be given for renunciation, we have to be given for normal right issuance also. So if it is given to existing shareholder, then copy of earlier RBI approval, because since we need to see whether actually they are holding the shares in the Indian entity and having reported all the earlier transaction as well.
This 90 days timeline for valuation, that's only for FCGPRS or also for FCTRS?
FCTRS also. FCTRS related to date of transaction. FCGPR is related to date of allotment.
And that's only since last year, because Akash is a little older.
For little older, everybody is seeking, even we also seeking only CA certificate date. We used to see CA certificate date. We never seen valuation assuming 31st March 2024, the company has valuation done. Even when they are giving 31st March 2025 certificate date, so we are allowing shares allotted today, we are allowing. Now we are telling them to value the company as on not more than 90 days. So bonus issue, copy and board resolution mentioning the ratio. Similar to that, a copy of LEA registration letter. Since there is no fund would be received in bonus issue, no FIRC, no KYC, nothing has been applicable. Conversion of ECB into equity. So ECB, I have not come across ECB. So ECB is one of the other capital account product where loan can be received from outside country. So initially client has received the loan, now they wanted to, instead of repaying the loan, they wanted to allot the shares against that loan. So that is also permissible. Similar to ODI, that they will have to make an agreement on a particular date that they wanted to convert loan into equity. Normally the loan would be INR, so we will have to see a notional rate on that particular rate and arrive the INR amount, and Indian security will be in INR, so to equivalent of that much amount they can issue the shares subject to pricing guidelines and other regulation. So again FCGPR to be filed within 30 days from the date of allotment. And ECB2 needs to be written mentioning that conversion into equity, if it is a partial, if it is fully. To statutory certificate, we need to require that ECB amount was received by Indian companies according with RBI guidelines. The certificate format we need to receive from statutory auditor. So shares can be allotted by way of merger, amalgamation, demerger, etc. in case of relevant approvals, NCLT or SEBI approval which required in case of merger, demerger, etc. So basis that merger NCLT order, we will come to know what is the ratio, against that the shares should be given by new entity to the existing shareholders of the old entity. So by way of that, if non-resident is involving, then Indian company, new entity has to issue shares. Because they are issuing shares as per the NCLT order, they need to file FCGPR with the reporting requirement.
This conversion of ECB can include the unpaid unserviced interest also?
Interest also can be allowed.
Similarly for the other conversion of loans given, so that can also be including.
Any payable. So that is one of the option, any payable, any receivable which is within the due period. Which is within the due period can be converted. Assuming you given the loan, okay, in the loan agreement it is mentioned that interest to be serviced every 3 months or every 6 months, okay. Now 6 months they are not serviced, now 1 year is pending, you cannot convert that, okay. Assuming 6 months means it has to come within 30 days, within 90 days, because due is 6 months, it has to be repatriated within 30 days. 90 days it has to be repatriated within 90 days from the due date of receipt of such fund. 3 months, 6 months, okay, but you are coming after 1 year to convert those equity, that is not allowed. If you are coming 7th month or 8th month, then it is allowed. Then it is allowed.
Only the remittance can happen or write-off can happen.
No, interest, you said interest to be converted, invest can be converted into equity shares.
No, but if the once the time is barred,
Once the time is par, it required RBI approval to convert. Anyhow, it's a delay, it's a non-contravention. See, it's a contravention under regulation, you will have to receive within 90 days whatever due applicable. Now in this case, since you have not received 90 days, then you will have to file late submission fee to regularize. So firms manual, we will have to, any entity who is receiving FDI has to be registered with the firm's manual. They need to create entity master and create a business user and get the user ID password, then they are allowed to file FCGPR. Earlier, prior to 2019, everything under manual, they will have to submit the entire set of documents to the AD bank. Now RBS easy for doing business, they said you can submit online sitting in your office at any point of time. There is no time restriction allowed that. So business user, so once they submit, that will go to RBI, then by basis the selection of the AD bank, that will come to AD bank portal, and AD bank will download the document and scrutinize it and approve the transaction. These are normal documents for FCTRS, share transfer agreement, valuation certificate, NR declaration, FIRC, NOC, all those things. So liquidation. Capital reduction. So this is normally when Indian companies, some of the Indian company want to go for liquidation or voluntary winding up. So when they are having issues with if the shareholders is a foreign party, AD Bank will normally used to see that whether all the FEMA compliances are being completed by the Indian company, because since they are winding up, that is the last process for them to complete closure in the Indian territory. So whatever the FEMA compliances done by them, it has been completed, because if any balance is left over, it will have to be paid to the shareholders of the Indian entity. So that point of time, that shareholder at the time of receipt of funds by the Indian entity, whether they complied or not, if they are not complied, they are allowed to comply first, then only they are allowed to repatriate the funds to the parent entity. Common FAQ document is not visible clearly. Sometimes since it is a image based portal, when they are uploading, sometimes the document may not be clearly visible by the AD Bank when they are downloading the document. Common spelling mistake in remitter and investor name. So if you see the FIRC, the remitter name would be different, and in the document which they are giving, board resolution and MOA, the name will be different. So AD Bank might seek clarity on that. Bonus allotment, whether firms filing is for equity, right, bonus, all sort of reporting, FCGPR reporting, but whether firms filings record for conversion of CCPS and CCD, answer is no. So there is no requirement to file conversion of CCPS CCDs, because at the time of issuance of CCPS CCD itself, it has been reported in FCGPR on fully diluted basis of equity. So third important is external commercial borrowing. These are the directions issued by Reserve Bank of India on this ECB. External commercial borrowing is commercial loans raised by eligible resident Indians. Who is eligible? An Indian resident means entity which is eligible to receive FDI. All entities eligible to receive FDI, they are eligible to receive ECB. That is a simple thing. So there are certain criteria which needs to be looked into that when ECB is available. That is eligible borrower. Second is recognized lender, so who can lend the money. Third is all-in cost ceiling, how much maximum cost you can charge against that ECB. Fourth is minimum average maturity, how much time the loan should be kept with the borrower. And the fifth is amount, how much amount the Indian entity can borrow. Sixth is what is the end use, they can what permissible end use they can use the money of the borrowing. So these are the main 6 heading we need to see. Forms of ECB loans including bank loan, floating fixed rate loan, bond, debentures, etc., which is not fully convertible. If it is a fully convertible debentures, that will be come into FDI equity. If it is a partially non-convertible, etc., all those will be form of ECB. This is loan. Loan can be received in dollar as well as INR. INR can be same whatever is applicable for FCY, INR can be applicable, and all beyond that they will also issue rupee denominated bond in overseas, which will be subscribed by overseas subscriber. Eligible borrower, discuss that all entity eligible to receive FDI. Further, port trust unit in SEZ, SIDB, they can receive. So this is INR, that is dollar. So INR, who can receive INR? All entities eligible to receive FCY ECB can eligible to receive INR. And microfinance activity, not profit organization, so those companies also can eligible to receive ECB, INR ECB. Recognized lender, the lender should be resident of FATF and IOSCO country, including on transfer of ECB. Normally will happen multilateral regional financial institution. So individual as lender can be done only if it is having equity shareholding in the Indian entity. Foreign branches or subsidiary of Indian banks are not allowed. Only they are FCY, ECB, they are allowed. This is minimum average maturity. So I said earlier how much time the loan has to be kept with the borrower minimum. So if it is a manufacturing company and if they are availing up to 50 million, then minimum 1 year is fine. If it is raised from foreign equity holder definition is one who is having more than 26% having direct equity. Second is indirect equity are holding more than 51%. Third is lender and borrowing having same parent entity. If lender and borrower is having same overseas entity, that also will be qualified as an foreign equity holder. So if ECB is raised from foreign equity holder for the purpose of working capital, general corporate, then it will be 5 years. If ECB raised for working capital from other than foreign equity holder, then it is 10 years. If ECB raised for repayment of rupee loan, which is availed for capital expenditure, then it will be 7 years. Similarly, if it is availed for capital expenditure, 10 years. So ECB cannot be raised from foreign branches subsidiary of Indian banks, B2E. That B2E is more important, only for manufacturing they can receive. So minimum average purchase, there is a formula, there is an Excel sheet which has been given. So basis, once we input drawdown date, repayment date, so it will calculate and gives you what is the average maturity. It's not door-to-door maturity which will be considered as average maturity. So that will gives you how much time, how much period the loan is with the borrower. So there is an Excel sheet which automatically calculate. Which category? And you please explain.
Say for example, we have a condition for manufacturing company.
Tell me.
And then there's a condition for working capital purpose. Say manufacturing company is raising ECB for working capital purpose. Then
No.
we should consider 1 year or
Only one, because here end use there which is for capital expenditure. The first one is for capex.
so can we say that low equity can be
No, the once the end use is working capital, okay, then automatically B would be applicable. If you find you given working you know that if it is capital expenditure, then it's not falling anywhere. If it is capital expenditure, it is not falling anywhere, then automatically 1 year. But normally it's a 3 years period. Not mentioned here. Normally for any loan ECB, its normal period is 3 years. Okay, these are all exception. Manufacturing unit, they are using for working capital purpose, then B would be applicable. Purpose is specific, that is fine. The first one which is applicable only for capital expenditure or import of capital goods, capital expenditure, rupee capital expenditure, etc. Other than these three, if they are availing for any purpose, then it is allowed, it's 1 year. Otherwise, normally 3 years. If it's other than manufacturing, it is 3 years. If service sector is availing for ECB for rupee expenditure or import of capital goods, then it is 3 years. It's not covered here. So normal period is 3 years.
So at the end of the maturity, they can refinance for other ECB.
Sorry?
At the end of the maturity, they can refinance with another ECB.
Yeah. The only criteria is when they are getting a new loan, the all-in cost ceiling should be lesser than that. Assuming the existing loan which you have availed for 4%. Okay. Now you are repaying that loan by getting a new loan, refinancing nothing, but you will not get anything. Only the new lender will pay to the existing lender. But when you are getting the loan, your all-in cost ceiling should not be more than your existing one. Existing loan is 4%, you cannot buy it 4.5 and repay that. It should be less than that. You can buy it for 3.99 and repay it. Which one, sir? After P, all is for non-equity holders. If it is equity holders, only 5 years is the maximum. Minimum should be 5 years. So all-in cost ceiling, existing ECB linked with LIBOR, they said 550 basis point. New ECB is 500 basis point. So INR ECB is 450 basis point. So So prepayment penal interest can be over and above this up to maximum of 2%. End use. So these are the end use which is negative end use which has been given. Earlier prior to these regulations RBI has given what are the end uses which is not given. Now open to that other than this you can allow for all other purposes when you avail ECB. So real estate activity you cannot receive ECB for real estate activity, you cannot receive for investment in capital market, you cannot receive for equity investment. Then working capital purpose you can receive only above B and C. Repayment, all the things is you need to see other than those below table now you cannot receive under this, but it doesn't make any sense actually when it is very clearly given. If you see 5B and 5C, okay, 5B they said that to be foreign equity holder. 5C said that other than foreign equity holder, okay. Then again in this they said you cannot receive more than above other than these two. So I don't know what other category falls into other than these two. First is equity shareholder, second is other than equity shareholder, that covers everything. But in restricted end use they said other than these two you cannot avail. Same is applicable for all. Change in currency of ECB, one change of currency ECB is allowed. Initially the client is availed the loan in dollar, so they wanted to convert that into euro, that is allowed. One foreign currency to another foreign currency allowed. One foreign currency to INR is also allowed, but once INR loan is taken that cannot be converted into foreign currency loan. So eligible borrower can receive up to USD 750 million in a financial year. So that is the maximum limit which Indian company can receive ECB. In case of SCY denominated ECB loan, if it is beyond USD 5 million, then they can receive up to 7 times of their equity if they are received in foreign equity holder. But however, if it is if the amount is less than USD 5 million, this debt equity ratio may not be applicable, and also this debt equity ratio is not applicable when the loan is received in INR. So this debt equity is applicable only when the loan is receiving in dollar. If the loan is denominated in INR, this ratio may not be applicable. Any issuance of any type of guarantee by Indian banks, All India Financial Institution, NBFC relating to ECB is not permitted. So only corporate guarantee can be given by the parent entity on behalf of Indian entity who is availing ECB, that is allowed, but no other security which can be given to ECB from Indian banks or any financial institution. Changes in ECB parameters has to be reported within 7 days from the changes reported. So any change, now most of the changes can be allowed under automatic route, like change of lender, change of AD, reduction of rate, reduction of payment, all sort of changes. Okay, so procedure for raising ECB. So client needs to file form ECB and along with the agreement an average maturity calculation sheet with the AD bank. The AD bank will scrutinize the document and will submit the application with Reserve Bank of India. And Reserve Bank of India post scrutinizing, they will give the loan registration number, that is LRN loan registration number. So post receipt of loan registration number only the entity can eligible to receive the fund from the lender. So the requirement is that mandatory requirement to LRN. So changes in terms of amendment to ECB, so that they will have to file again revised form ECB mentioning the changes, that has to be given within 7 days from the date of changes to be happen. Monthly reporting of actual transaction. So there is a monthly reporting of ECB. What are all the ECB2 every month till the time of closure of ECB, the client needs to file form ECB2 return within 5 working days of the subsequent month. Normally that covers what is the drawdown happened during the particular month, what is the repayment happened during the particular month, what is the utilization of the fund which has happened during the month has to be given month on month basis. This has to be given to Reserve Bank of India through your AD bank, this reporting till the time it was closure. So so this also late submission fees for delayed reporting, similar to other delayed reporting. 7,500 would be the delayed reporting if they are filing beyond 7th working day. Changes of AD bank. So AD category change of bank also can happen, assuming client is holding an account with ICICI Bank and having the LRN through that bank. If they wanted to change, if they wanted to close the account with ICICI Bank and open the account with SCB, so they can give change of AD for that particular LRN and get it changed to Standard Chartered Bank. Conversion of ECB into equity, similar to already explained to that, the loan is outstanding. So they, instead of making payment to the lender, so they wanted to allot the shares to the lender, so that is allowed, subject to FDA regulation and ECB regulation. Okay, so that is okay. We'll go with the last one, establishment of license office, branch office and project office. Though this is not a transaction, actual transaction, there are certain liberalization or delegation which is given to the AD bank, like foreign entity can establish a license office, a branch office and project office in India. So there are certain regulatory compliances for license officer in India. So foreign company can open a license office. So the minimum requirement for opening a license office is they should have a preceding 3 years continuous profit, and they should have a net worth of not less than $50,000 as per the last balance sheet. Activity of LO, so representing the parent company, group company in India, promoting export import from India. So normally they will not do any activity which takes revenue for them. They will be only licensing on behalf of parent entity into India and look out for any business opportunity to create a subsidy or to develop further future. So initially license office is the one, they will come to India to see the business opportunity in India, whether is there any business opportunity. So for that they can open an office in India. So initially the approval will be given for 3 years, and post which they can extend for every 3 years, they can extend the license office. Permissible credit to license office is funds received from head office. Since there is no revenue activity in India, whatever the funds required to maintain their office, maintain their staff, the fund has to come from their parent entity outside India. And refund of security deposit paid by LO's account directly by head office, that also can be credited to LO's account when they want to close. So refund of any tax duty received from tax authorities, that also can be received. And sale proceeds of asset of the LO at the time of closure, that also received. These are the only 4 credit can be received in license office account. So next is the branch office account. Branch office account, similar to license office, there is a minimum requirement of preceding 5 years continuous profit should be there to establishing a branch office, and a minimum net worth of USD 1 lakh should be there. Form FNC, that is the form needs to be given when they are filing application. Certificate of incorporation, banker's report, KYC, MOA, AOA, all those things to be given. Letter of comfort. Letter of comfort is one important document wherein the foreign entity which is establishing a branch or license office in India who do not comply with the requirement of minimum 3 years, 5 years, or do not comply the requirement of net worth of 1 lakh, then they can get letter of comfort. So letter of comfort who can give? Any parent entity of the foreign entity who complies with this particular compliances of 5 years profit or net worth of 1 lakh, they can give letter of comfort to open a branch office account in India. Otherwise it is not allowed to open. So activity of branch office. So activity of branch office is other than manufacturing. So they are allowed to do export import of goods, rendering professional consulting services. But doing branch office activity, they can generate revenue in India, because since they are doing services activity in India, they are allowed to receive remittance and sale proceeds to their parent entity, or they can repatriate the profit to the parent entity. So there is no validity period for branch office unless license office. Unlike in license office, we have 3 years period, whereas branch office there is no validity. Permissible credit is funds received from head office and legitimate receivable arising the process of banking operation. Debit expenses incurred by the bank and remittance of profit and winding up proceeds can be remitted back to parent entity. Approval for LO, VO. So document to be scrutinized. So document will be given by the client with all the supporting documents. Once AD bank checks the document and in principle okay, then they will send it to RBI for obtaining UIN, unique identification number, post which RBI will issue unique identification number. With that unique identification number, the bank will issue separate approval letter to the foreign entity to open a license office. The LO, as I said earlier, validity is 3 years, BO there is no validity. Within 6 months of the approval, they will have to give address proof, ROC and PAN needs to be provided. If they are unable to get it done within 6 months, then they will have to get extension. That extension can be given another 6 months by the AD bank. If they have not established the office even after completing one extension, that means within 1 year period, then it has to get RBI approval. Bangladesh, Afghanistan, Sri Lanka, Iran, China, Hong Kong, Macau, Pakistan registered. So any entity which is come from this country, they will have to register with state police authority of their district, of their state. There is a format which is given how many employees are there, all those things they will have to give the details to state police authority. Additional offices, so that is for initial one. If any additional offices, they can get, assuming for every zone, they can open one additional offices without any RBI approval. If exceed 4, then justification is required. That means south, northeast, southwest. So each of the region they are allowed to open 1111. Okay. And similarly, not more than one can open in a particular region. If client wanted to open, assuming they are already holding approval for Chennai, if they wanted to open additional offices at Bangalore, so both falls under south, which is exceeding one in a particular zone. So that required RBI approval with a valid justification. So if they are holding more than one offices, assuming they are holding one in Delhi, one in Mumbai, one in Chennai, so they will have to appoint one branch as a nodal office and to ensure to filing all the regulatory document with the AD banker. Shifting to one city doesn't require any RBI approval, but if shifting to another city which require prior RBI approval. Changes in postal address to be intimated to central office. So any change in address of the branch license office that has to be intimated to the AD bank, then we will intimate to the Reserve Bank of India, because at the time of application, that is the address, one address should be given, or within 6 months they need to give the address, local address. So once that will be intimated to RBI, if any changes is there, that has to be intimated to again with RBI. Opening a project office, nothing but if any foreign entity who is having a contract, Indian company is giving the contract to the foreign entity, they are allowed to establish a project in India. To execute the project, to receive the account transaction, they required account to be open in India. So they can approach with the Reserve Bank of the AD Bank in the form of Form FNC with a valid contract copy executed between the foreign entity and the party who is given in India. So they are allowed to open 2 FCY account, one FCY in USD and another FCY as per their home country. If a Japanese entity wanted to have a project office in India, they are allowed to open USD account as well as JPY account and INR account as well to do normal transaction. No RBI approval required. Funding is 100%. The funding is coming by 100% parent, or the funding is coming from the project governing authority. Only these 4 only the fund can be received. No other person can give money to the project office account. Intra-project transfer requires RBI approval. Assuming one particular entity, Halliburton offshore entity, who has got the contract from Reliance Industries and also he got the contract from ONGC. So for Reliance Industries, they will have to open a separate INR account. For ONGC contract, they'll have to separate INR account. They'll have to get separate approval for both this contract. So the fund cannot be movement, cannot happen from one INR account to another INR account, being it's a different project. So that requires prior RB approval. So bank account needs to be closed. Once project is over, they'll have to give the closing document to close that INR account. Document required, normal document, copy of MOA, certificate of incorporation, copy of agreement, undertaking from Indian entity that money would be flown only from parent entity or from the project governing authority, etc. Banker's report from the applicant, banker, and undertaking from the company. This is the normal thing. They cannot, other than execution of project, they will not going to do any other activity. They will have to choose only one particular bank for designation for that entire project. For different project, they can assign different AD bank. Closure of project office, once the project has been closed, they will have to give document confirmation from the project governing authority that project has been closed. CS certificate to be given that the project has been completed. Financial report. So with this document, we can, the AD bank can allow to make the remittance towards closure of project office. So regulatory requirements. So what are the regulatory requirements for that annual activity certificate? Similar to UI and APR. So any foreign entity who has established an office in India, they are bound to give audited financials every year. Needs to be given before 30th September. If they are, if their account is on 31st March, they will have to give before 30th September. If they are following the accounts other than March, then it has to be completed within 6 months from the date of closure of account. Audited financial statement is required. Acknowledgement copy of, there is a DGIT, they will have to LO and BO required to submit DGIT also, that annual activity certificate along with that financial, they will have to submit DGIT. That submission copy, they will have to give it to AD banker. DGP, in case of specific country, we have seen that Sri Lanka, etc. So they will have to give report to the state registered, state headquarters of the police. So that copy also they need to give to the AD bank. Extension of LO and PO. So as I said, BO there is no validity, extension requirement is not required. LO initial approval will be given for 3 years. So before closure of 3 years, before 1 month, they need to approach to the AD bank again to extend for another 3 years. PO normal validity period is till the time contract it will be mentioned. In case of any extension, the contract is being getting extension, they will have to get approval from AD bank to extend the project office. We need to get the revised contract terms from the contract governing authority. Transfer of asset. So there are certain assets which are lying in. So transfer can happen only at the time of closure of license office, branch office, project office. So when license office completed the transaction, when branch office completed, they want to close the branch office. That point of time, they have certain assets on it. They can sold those assets. Earlier it was under approval route. So now they given the automatic route. So we'll have to see whether they have completed all the regulatory compliance formality till the previous financial year. Then we'll have to see statement from statutory auditor. The asset can be sold only on the return on value. We'll have to see that one, depreciation till date, etc. Statutory auditor also give the confirmation it was not revalued after initial acquisition. Statutory auditor again will coming that no intangible assets such as goodwill, etc. included in the transfer. So declarations, all taxes has been applicable, etc. So with the approval, the AD bank will allow them to sell the assets and get the money into be credited into LOBO PO account. So ROC, they need to get the ROC registration by any entity which is establishing LOBO PO. PAN number, they need to obtain BO and LO, record to obtain PAN number as well. So one authorized dealer AD for reporting. Change of AD is allowed with an NOC from the existing bank. The FD can be a branch office can allow to keep the money into 6 months, they can keep it in FD, not beyond that. This is not applicable for airline shipping company. Name change of LOBPO, only change can happen with BR and ROC. That will be intimated to central office. In case of name change, in case of acquisition, merger and other regulatory thing, then it has to be closed and to open a fresh name in the name of fresh foreign entity. Not more than one account for LO without RBI approval. In case if LO wanted to open another account, then that required RBI approval. As we said, project office can have two FCB accounts, one in USD and another in their local home country. That's it, I think. Have any other questions? Because I don't have time actually. Still, I'm okay to take up any questions which you have. Huh? Huh?
So, can a family trust hold foreign securities?
No. That's not FDA, ODA.
Yeah. Even if it's transferred to the
No, trust is allowed to invest only in only the under Schedule 4. If you see, if the trust is into education and one particular purpose, only they are allowed to invest. Not any other family trust is not allowed.
Foreign company opened a license office in Chennai,
Huh.
and they want to close it. The procedures can be transferred automatically or distributed.
They will have to see, they open the license office, they wanted to close, okay. At the time of closure, we will see whether all the reporting have been completed till previous financial year. ROC has been obtained. They got the ROC for closure? They need to first ROC for closure. ROC is the main document which says that your operation has been closed in India. Then transfer the fund at the final stage. Then you will have to give CA certificate, how you value the asset, etc. All those things will be, there are certain document which is required. So once you give the document, along with that you can give the remittance application, then payment will be made and project license office will be closed. Yeah.
In case of LLPs where non-residents are partners,
Ah.
whatever is the share of profits earned from that LLP, can the non-residents transfer it as current income earned during the year? Not under the 1 million limit, but as income earned during the year. FEMA also allows the non-residents to transfer any income earned during the year.
Correct.
So can they transfer share of profits received from LLP as current income or income earned?
Yeah, why do they need to give it to NRO account? They can directly repatriate to outside country, no?
They can. The LLP can transfer it.
Ah,
That way.
correct.
But if it is done to the NRO account, it is done for operational basis if they improve it to the NRO account, can the non-residents subsequently take it as part of their current?
Yeah, it can be done. That depends upon the bank to take call, because some banks will stick with the USD 1 million irrespective of whether it's a current account or capital account. But if you can able to establish this particular amount which is as a current income, okay, then they are allowed to remit more than USD 1 million. Because that 1 billion cap is for capital account, I mean any sale of asset, etc.
So also if the NRIs happen to be the beneficiaries of a trust or they receive the share of income from the trust, can they move that as current income?
Now, who has invested into LLP?
No, LLP question is over. I'm asking about a separate question where the NRIs are recipients of, they are beneficiaries of a trust. The trust is private trust.
No, trust is a different altogether. FEMA doesn't talk much about trust. Okay, when trust is receiving investment, how under which schedule they are receiving investment in India?
No, the non-residents have already settled their assets into the trust. The trust is
Correct.
earning
Trust is
income.
earning income. That you mean that trust in India not received any money from outside India?
No. It is an NRO. It is an NRO.
Ah, okay,
So the trust is earning income
okay.
and the trust is distributing the money to the non-residents. And that money can be taken out as current income. Because whatever the trust is distributing is all income earned during that particular year.
Correct. But I think there is a stipulation who can be the beneficiary of the trust, etc. So we are not sure actually, because nowhere it is covered under FEMA. So that is a separate act which is governing trust. Whether non-resident can be a beneficiary of the Indian trust, then the details would have been given over there, whether they can repatriate the funds, etc. Is there anything? Because
No, the
FEMA nothing.
trustee does not call for that information it's not mandatory to record, but since the beneficiaries happen to be the non-residents, purely from a FEMA angle, is there a specific
FEMA
provision that
angle,
allows?
you see that they have not invested any money from their account. You mean to say that earlier they invested from NRO account?
Yes. It's an NRO of financial assets. They have contributed to the trust. The trust is converting that into various other financial assets.
So we need to check this one because I have not handled this thing actually. We'll have to check with the actual details with the internet team to get to know that much. Because trust normally we don't entertain question from trust which is not a clear-cut area which is given by RBI. If you see LRS, even trust cannot able to send LRS. So individual method, individual only.
A resident in India is planning to open a company in the US. And this company does not have any share capital. So it's a limited liability company which gives only membership interest. So it's a sole member of this LLC. In this regard, is there any complaints that I need to do with the AD bank, like presenting the form FC, something like that? Because
Form FC to be given because he is having interest. He will get interest or unit from that particular entity, correct? Interest or unit?
interest, membership interest, but
Membership,
not
partnership
transfer
interest,
funds.
partnership interest, whatever the percentage, assuming 50% or 100% is getting. That will qualify as an ODA only.
But I'm not going to transfer any money from here to there, not even $100. So it's like zero paid up capital.
No, it's not like that actually, because though it is practically possible of not getting any money from India to incorporate a company, however, regulation doesn't talk about getting a share with a free of cost unless it is received by way of gift. Okay. Individuals are allowed to receive by way of gift only from close relative up to INR 1 lakh subject to FCRA approval if it is beyond 1 lakh. So there is no other provision which is given in regulation. Initially I said that whatever is not specifically given which is not allowed. Okay, he is getting in partnership interest or is getting an equity interest which is not been given in the regulation. So that means which is not allowed. They will have to pay the money to acquire those shares. They will have to somehow make some amount to be paid against that interest and to make the remittance to get it regularized by filing Form FC, etc.
The payment has to go.
Payment has to go. Payment has to go.
Sir, usually the accrual on investment made outside India, sir. Whether that amount should be brought back to India, the income what accrues outside India.
Yes, this is ODA, okay.
Yes, sir.
ODA, we said no, it's 90 days from the date of due date. Assuming investment means which investment talking about? Not ODA.
Not ODA, sir. Like an individual.
Individual investment in a fund, assuming it's a fund OPA, okay. If any realization which has to be repatriated within 180 days.
The realization of what? The principal or the any income?
Whatever realization which he has received.
Anything can be anything.
Anything. He cannot keep it within more than 180 days. Within 180 days, it has to receive it back in India. See, Indian resident individuals are allowed to open a foreign currency account to undertake LRS transaction. Okay, assuming they have sent the money from here, $50,000. Okay, he's kept the money today. Yes, 1st January he has sent the money 50,000, telling that I'm going to invest in a listed company outside India. Okay. On 1st August, he has not yet utilized the fund. Still money is lying in that books of account. So what RBI said that when you send the money which has not been utilized for 6 months, it has to be refunded back to Indian account. Similarly, you have invested, also you invested into the particular company, you sold the asset, you sold the units and get the money into your foreign currency account. Okay, now money is lying in the foreign currency account. That money has to be reinvested again or has to be returned back to India within 180 days. You cannot keep the money as it is over there because many think what happened, in the RBI is given 250,000 every year, okay. People are every year they are sending 250,000, accumulating the fund outside country. Without utilizing, they are just accumulating outside country. So they said that is the reason they said that it has to be refunded. It has to be utilized for the purpose for which it has been sent from India, or it has to be refunded back within 180 days.
But there is no reporting format for that, no, sir?
No, no reporting format. But it's non-compliance. If you are not doing, see, sitting in India, nobody is going to aware when you receive the money in outside your bank account. Okay, but regulation says tomorrow if somebody catch hold, then they will see statement of account. They will see why you have not utilized. That time they will quote this regulation.
But we are also repatriating even for family maintenance and savings outside India, LRS. I think that's the most common mode that people use,
Correct.
right? So in that,
Your own account.
my own account, correct. For store account,
This is applicable only to your own account. When you are sending maintenance to your brother,
my own account. Let's say I plan to travel. I want to use
correct.
the money I have.
You have planned for travel, you send the money. If you are not utilized within 180 days, that money has to be refunded back.
Is that specifically there, sir?
Yeah.
LRS,
2022 regulation. Prior to that, it was not there.
But wasn't there a clarification from RBI that the end use of LRS remittances will not be looked into as long as the source is clear?
No, any realization or which is unutilized amount has to be refunded back. Because everybody is sending the money for accumulating purpose, same no, they are not utilized for the purpose which the money is sent. You have sent the money for travel, but you not utilized for the travel, no?
No, I'm sending it for, I have not said I'm sending for travel. I'm using that code, common code that people use, right? Family maintenance and savings account.
Okay, family maintenance saving. Okay, family maintenance you have sent.
I can use it after some time.
No, that is only they said not allowed. Similar to that, no purchase of property. You said purchase of property, but I am not purchasing now, I will purchase after 5 years.
How will I purchase $2,000, sir? That's very less.
That's why they said, no, that's other way they given that consolidated family members, you can send the money and purchase the property. So it has to be utilized. That's what I remember. It has to be utilized or should be refunded back. So one is realization of the money, which something realized money also cannot be kept over there. And whatever the money sent also cannot be unutilized beyond 180 days.
If the person has subsequently become a non-resident, then even then,
Then okay, then okay.
they realize money can just be kept out.
Then okay. Because whatever earning now, he will earn at the time of NR. The whole regulation would be applicable as long as he is there, he is in NR, he is in resident category.
One more question is that LRS is applicable only into residents.
Ah.
But some bankers are asking even for telling the non-resident, they are limit is $250,000 per year.
Non-resident USD 1 million under NRO account.
They are not accepting.
How come?
The
No.
limit is 250 or exceeded.
Ah.
You cannot transfer, you have to get RBI permission.
Is it in the books of AD Bank is showing still resident or non-resident? I think sometimes what happened, the resident, okay, is continued to be resident. 2 years back he became a non-resident. He is not informing to the bank. Okay, is going, coming because bank may not know unless the individual goes and tells the bank that I become NR now. You convert my savings to NRO account. Okay. The client might be NRI, but he is not intimated to the AD banker. Now, if we want to utilize that money, then again it will be resident only, as per a bank's record. So then they will see the statement of account, they will see resident account, they will continue to say USD 250,000 only. So client needs to intimate to them to convert those resident into NRO account.
Can shares be issued as consideration for the services received from the non-foreign entities? In that case, whether the valuation
Everything, valuation, pricing, the time limit under which the funds needs to be received.
but there's no fund
Services you have done, correct? Services you have done, services you have availed, correct? Services you have availed. That services availed when you are supposed to make the payment within 9 months from the date of service, or within 6 months. Some timelines is there, okay? Within that you have to make the payment. So instead of making payment, you are allotting the shares. You will have a proof of agreement. You will have a proof of invoice, copy of invoice. No, that proof that you have some payable to the foreign entity. So capitalization of export, that is capitalization of export, the shares can be issued against any payable to the foreign entity. Okay. Any other question?
Any other questions, please? Then we can wind up.
So thank you very much patiently listening.